Now going into next year, everyone is bearish, right? And we're going to have this massive recession.
It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers and may roll through some of the other sectors in the economy.
Even if we see growth hold up okay, we don't fall into a recession.
We've never had a recession without the claims data going up.
We're expecting a mild recession, but we don't think that it's going to last long.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowicz.
Good riddance, leaving behind the worst year in more than a decade. Good morning. This is Bloomberg Surveillance on Bloomberg Television with Kailey Leinz and Matt Miller. John and Tom both off today as we herald the last trading day of a year.
Finally.
To forget, Kailey.
It has absolutely been a year to forget, and that is true if you were invested across asset classes. Worst year for stocks since 2008. Worst year for 60-40 portfolio since 2008. Even longer, I believe, for global bonds. It has been absolutely brutal in a way that no one saw coming at this point a year ago.
But not no one, right? There were some people who knocked the ball out of the park this year. So if you were short rates, for example, you were on fire. So I think a lot of people had pretty good 2022.
Okay. Blockbuster if you were short.
Yeah.
An absolute travesty if you were long.
Yeah.
Even more of a travesty if you were long tech stocks, right? With 35% average decline on the NASDAQ 100. The key question is, how much do you pivot, sorry to use that word, for next year? Because how much do we see the worst of it versus just the beginning?
Yeah, this is actually what I've been thinking about a lot lately. How important is the change in the number at the back of the 4-digit year? I mean, the calendar change doesn't necessarily mean you have to change your strategy, right? Maybe you wait to pivot until after the first quarter if you get, as one of our guests is going to tell us today, executives throwing the kitchen sink at it in Q1, saying, all right, the consensus is for a recession, so we're going to throw everything in Q1, and then maybe it looks better from there on out.
Although this is the consensus, right? And Kailey, you've been talking about how despite some of the optimism that we saw out of economic data, despite the optimism that we've even seen from a number of companies, we haven't seen that Santa Claus rally. We haven't seen the typical year-end melt up, and you've heard about tax selling, you've heard about a lack of liquidity, but there's something else going on as well.
Yeah, I mean, it would be really tough to convince yourself it's okay to be long after a year like this one. To your point, it's been brutal if you were long. And to Matt's point as well, yes, the calendar changes. All of the problems we've been dealing with this year don't just magically go away come January 1st. You are still going to have a Federal Reserve that is going to continue hiking, at least in the first quarter, an ongoing war in Ukraine, still questions around the COVID trajectory in China, and corporate earnings that have not actually seen those estimates falling in a material way yet. And everybody says those got to catch up at some point.
A lot of negatives. The one positive that perhaps people will point to, and it's a big one, is that perhaps we've seen inflation peak, right? And that has been the big question. 2022 was the year of inflation, the fastest pace of inflation going back 4 decades. And we have seen it roll over and continue to do so, Matt. How much is that enough to give people the oomph to keep going and be sort of a bit more constructive?
Well, I guess it depends on a couple of things. A, it depends on how quickly you think inflation is going to come down, right? The Spanish data that we got this morning was surprising in that sense. And we've heard more and more people say they think it could be a rapid decline. Ed Yardeni, for example, yesterday said it's probably likely that we could get a soft landing, or I think he might have said no landing at all, which would also be good, right? And then it depends on your belief in, your faith in the credibility of the Fed. Do you think that this Fed that Jerome Powell wants to be, another Paul Volcker, is he willing to do whatever it takes? I guess that's really Mario Draghi. Do you think that he's going to fear high unemployment? He's going to fear a real contraction in earnings and then turn tail and cut rates and pivot even in this year?
We're not going to recoup 20% losses today because we're already down in pre-market trading, just taking a look at where we're going to end the last trading day of 2022. You could see a mild decline in the S&P in particular, with shares down about 1/3% to start the day. You're seeing a bit of dollar weakness. Again, this is sort of interesting in light of the dollar strength. That was also a theme for a lot of this year, 106.77. 10-year yields up just marginally, 3.8482% to go out 4 digits. But just to start the year at 1.5%, and to go to this level gives you some sense. If you look at 2-year yields, they started the year, they ended last year at 0.72%. They are now north of 4.2%. Just a massive exponential rise. And crude, fascinating to me to see the round trip in crude, $78.38 at a time when you have the war still raging in Ukraine, and you also have this concern about where Europe is going to get its supplies. But Kailey, and I do have to ask this, really, how much does the entire inflation debate get colored by what we've seen in oil prices, what we've seen in natural gas, slumping for the most going back several months simply because it has been a warm winter?
Well, that's a very good point. Guy Johnson this morning was talking about how it's going to be T-shirt weather in Berlin on New Year's Eve. And that definitely has helped Europe on the energy side, where so much of the inflation, at least in the earlier part of this year, was coming from. But you have started to see it bleed into other areas of the economy. It's in services. That is what central banks are trying to rein in. So no longer is it just about checking the price of oil and the price at the pump. It has bled everywhere. And that is the concern.
Well, let's get a sense of where to go next year and how to forget the one that we just had. Michael Purvis joining us, CEO of Talbot and Capital Advisors. How bad was this year? In other words, how wrong did people get it, and what are they getting wrong heading into 2023?
Like, from 2022, what I certainly got wrong coming into it, was the persistence of inflation, which I underestimated inflation, which means I underestimated rates, which means I overestimated the PE that the S&P 500 would maintain. I guess what I've learned from this year, though, is that in looking into next year is that I think, look, the path to lower inflation in many facets of inflation is pretty obvious. You were talking about goods inflation contracting and gasoline prices and so forth, but the problem I have with us getting anything back to what we experienced from the few years leading up to last year, in other words, sort of a buy the treasury debt, which means a buy the equity debt, is that there's new structural inflationary forces that are going to come in to 2023, just as some of the COVID specific or COVID related inflation has really been sort of processed there. And those forces are relocalization of supply chains, and it's this new sort of theme of very structurally tight commodity supply there, and a general sort of sense of capacity discipline from a lot of the corporate world there. And of course, there's this lingering question about the employment structure in our country and all that. And so I think there's going to be
Michael,
yes.
When you talk about employment, we've been talking about NARU a lot the last couple of days. Does the Fed have to raise rates until unemployment is up near 5% before they can really get inflation back to the 2% target? Or is inflation naturally coming down? I mean, you're in Spain right now, and they had some pretty good data today.
Yeah, they did. And gasoline prices here, I filled up the car yesterday, and I was pleasantly surprised there. Look, again, a lot of that is reflecting, the sell-off in many commodities that, we've been seeing here. But look, as it relates, if you look at the employment picture, the layoffs that we've been seeing have been coming from the places that you didn't get unemployment from in the last few years, meaning big tech, for example, right? And many facets of employment are really, really tight. Look at oil and gas hiring. It's actually been lower now than it was 6 months ago. So, that's a very robust sector. I know people in the oil and gas industry, you just can't hire people to get on oil rigs, even if they pay massive premiums to whatever they paid before. There's structural problems in the employment thing besides just the retirement issue there. We're going through a big, I call it revenge of the old economy, which means that a lot of the employment picture is very, very tight here. So,
well, on the point of employment, Michael, I was speaking with Eddie Vanderwalt, one of our Markets Live columnists, earlier this morning, and he says what actually he thinks people got wrong this year is how resilient the labor market really was going to be, that it was going to remain so tight, and that would make the Federal Reserve's job so much harder. If that continues to hold true, if what is objectively should be good news, that it's a resilient American consumer and American labor market, how detrimental could that be for risk assets?
Well, I think it depends on how, I think Powell's going to be resolute about the 2% target, and he's going to be hawkish so long as he sees signs of inflation, particularly wage inflation. That gets to Matt's question about the unemployment rate. I think there's a second order question, though, which is, does he do it just by sort of violently signaling more and more rate hikes, or does he get to terminal sometime in Q2, 5.25, pick your number, and just change paths to sort of keeping it at that plateau level a lot longer, even if inflation goes down lower, even if the economy starts contracting, even if unemployment goes up. And I think that may be to me, it's a lot more about how he's going to be a hawk than, if he's going to be a hawk, because I think he's got to be a hawk. And again, I think sometime in the second half of next year, you're going to start seeing the effects of you look at capital utilization, it's at 80%.
Yeah.
That's pretty high by the standards of the last decade. If you get all this sort of capex boom from relocalization pushing up against that, that's going to create a new inflationary force that Powell's going to have to contend with. It's a different type of inflationary force than what he's used to dealing with, but I think it's a new thing. And if China does continue to reboot itself, that's going to put upward pressure on commodities there. So I think it's a very complex and nuanced inflation picture, but a lot of collapsing inflation and a lot of sort of new structural forces keeping the floor higher there, which means getting from, say, 3% to 2% is going to be tough.
Yeah,
and that's where I think he's going to end up, rather than getting to 5.5 and 6 and 6.5. He's going to more just keep it at a high level for a very long period of time, or at least by historic standards.
Michael Purvis, unfortunately, we have to leave it there. Have a wonderful new year. Thank you for all of your contributions to Bloomberg Television. Michael Purvis of Talbot and Capital Advisors. You're talking about all the different potential variables. I have to take a look. We were talking about a weaker dollar, and the weaker dollar, particularly versus the Chinese renminbi, is notable to me, falling to the lowest level that we've seen going back to September, 6.9067, a real dramatic move as you see this reopening and this feeling that perhaps the COVID cases, Kailey, have peaked in Beijing and other big cities, even as they continue to spread in other areas. The fact that you see that economic activity just surging back, public transportation
that
ridership.
mobility data is what is so telling. We're approaching the Lunar New Year holiday as well, which traditionally pre-COVID was a big economic period for China. It's a question of A, whether that's going to drive more COVID cases, but B, do we see that revitalization and the spurring of demand in the second largest economy in the world?
Coming up, we'll follow up on that. 7 a.m. Dana Daria, co-CIO at InvestNet, will be joining us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine. Meanwhile, China has named its ambassador to the U.S. as the new foreign minister. The appointment of Qin Zhang is viewed as a sign that Beijing is moving back to a lower-key diplomatic strategy. Qin has delivered some of China's most moderate messages on hot topics, such as the war in Ukraine. And the U.S. may give Ukraine's ground fighting capabilities a boost. Bloomberg's learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25-millimeter gun. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was part of a push to influence crypto policy and build connections before his FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. And in Canada, the merger court has cleared the way for the union of 2 of the country's biggest telecom firms. The Competition Tribunal ruled in favor of Rogers Communications' $14.8 billion deal with Shaw Communications. The ruling said the federal antitrust commissioner failed to prove the merger would cause significant harm to competition. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
The problem is you cannot change the goalpost when you haven't won the game. And so changing the inflation target from 2% to 3% when you haven't achieved your objective would be a serious risk to the Fed's credibility.
Choppy road ahead. That was the take that we heard from Dalip Singh, chief global economist at PGIM and former economic advisor to President Biden, talking about what we're going to expect in 2023 with a Fed that seems determined to keep going regardless of what you were talking about, Matt, with a higher unemployment rate. It seems to be consensus that, yes, the Fed is going to do what it takes, maybe, but not too much. That's sort of the way that things are going down.
Right. I mean, every economist we talk to says, yeah, inflation could get up to like 4.7%, even if he or she says that Nehru is higher, right? If the idea is to fight inflation, especially in services prices, I'm no expert, but what I hear is you need to drive unemployment higher, which is pretty scary.
Meanwhile, the other thing that was sort of consensus, Kailey, earlier in the year was this idea that because of inflation, you wouldn't see any kind of legislative spending. You wouldn't see fiscal stimulus. And President Biden just signed off on a $1.7 trillion funding package that increases the aid to Ukraine. And a lot of people, it has bipartisan support. A lot of people pushing back against this fiscal austerity and saying, no, they're going to keep spending because there is no legislative will to really reduce the deficit, despite some of the inflationary concerns.
When you have so much that needs to be paid for, I do wonder how that becomes more difficult when you do have a Republican House and a divided Congress come a week from now, come January 2023. And it raises the question as well, you know you're not going to have the support on the monetary side if we see a softening of the economy. If you don't have that fiscal impulse as well, what does that mean about support for the American people if we do indeed fall into a recession?
That's honestly what a lot of people are looking for, and yet it might be there anyway, despite the inflationary concerns.
Well, and we know that Congress is no longer just worried about inflation or about spending. They also have been very concerned over the course of the last week about Southwest Airlines, which says it will be resuming a normal schedule today after canceling more than 13,000 flights over the course of the last week. Let's get to Ed Mills, Washington policy analyst at Raymond James, for more on this. Ed, I do understand that if your constituents are frustrated and angry at a company like Southwest, you also have to express frustration and anger. But why has so much attention been paid to this? I have to wonder if it is tied in a material way to the fact that airlines, including Southwest, received so much aid during the early days of the pandemic.
Yeah, Kailey, absolutely. I think when you look at this issue, you look at how much money went in the CARES Act, other COVID relief to the airline industry. You look at the capital management of the airline industry when it goes to resuming a buyback or a dividend. And then you look at the impact on individual lives. There would be two things I'm looking at from here. Number one, what does the Department of Transportation does? We have Mayor Pete Buttigieg as the Secretary of Transportation. It is very clear that he wants to run for president either this next election cycle or very soon thereafter. He has to show something for his time. He's had an infrastructure bill, but if he doesn't show that he understands and responds to this, that's a political crisis for him. The second thing I'd be looking for is the FAA reauthorization, which expires next year in 2023 on October 1st. And that's a great opportunity for Congress to add consumer protections or consumer rights, especially the requirement to rebook on another airline in an epic meltdown like we saw this last week or what we saw earlier in the summer. Remember, this is not the first problem of the airline industry this year. So as we go into next year, there's a significant regulatory and legislative risk for the industry because of the performance and because of the bailouts for the industry from COVID.
So, Ed, does Southwest have to pay people before they pay their dividend? You know, they're scheduled to resume dividends, $400 million in payouts next month. At the same time, Kailey just said 13,000 flights were canceled. That's like over 1 million people, right? So if you want to give them each $400, that's just about what they're paying in their dividend.
Yeah, I think it's, for consumers, for the political press, for the, kind of the financial press, that's going to be the question. Currently, the regulation, it's unclear how much you can really fine the industry. But I do think that this is a kind of a perception problem, kind of in politics when you're explaining you're losing. And so to have to say, why did consumers not work out the way in which they think that they should have? Why were they stranded? And why is the, kind of the shareholder getting compensated? That's going to create this political problem that I was mentioning, both at the Department of Transportation and within the halls of Congress. And we've seen in the past, kind of going against the airlines can be a very bipartisan effort. We'll work out the details, but it's a big risk.
Well, they could adopt the kind of compensation legislation that Europe already has in place, which is, I guess, about that tune, 400, 500, 600 euros for this kind of issue. Let me ask about the other changes with the Republican Congress. Is President Biden likely to be impeached?
Matt, I think it's unlikely right now. We'll see where kind of the year goes. I do think that the one thing that we are very likely to see in the House of Representatives is a significant uptick of investigations. We'll see where those investigations go. I do think that a number of Republicans in the House will call for impeachment. Whether or not you can get to 218 votes, that magic number of a majority in the House, remains to be seen. I think you'd need to uncover something that we don't know right now before you get that. And then the question after that is, does that help out Republicans, or is there a further backlash? We've seen kind of political investigations certainly have political backlashes as well.
Everything we've talked about so far, Ed, whether it's the Southwest, whether it's the political intrigue in Washington, D.C., strikes me as window dressing at a time when you have the conflict in Ukraine that is accelerating, and then you have a reopening in China that's raising a lot of concerns about the possibility of a new variant. What's going to be top of the agenda when all of the Congress members get back to Washington, D.C. in January?
Yeah, Lisa, I've always thought that kind of the number one thing that we could expect out of a divided Congress is a tough on China bill. The most bipartisan thing in D.C., kind of putting aside some of these airline issues because we respond to the latest headline, is getting tough on China. The only place of political vulnerability is being seen to be soft on China. What that could look like is further tech restrictions coming out of Congress. Are we going to see any travel restrictions if we see kind of COVID spread further? You see that already reacting from the Biden administration, putting some travel restrictions on kind of inbound flights from China. We'd be looking at certain new kind of investment restrictions. Is there going to be a push for a ban on TikTok? There was a ban on downloading TikTok on government devices. How much does that expand? I think that's a top of the list to do, because a lot of Republicans and Democrats feel as if we still have a lot of concerns about the trajectory of China and kind of the investments that are going from the United States and the technology transfers that are going on from the United States into China. So, Lisa, that's probably the number one legislative accomplishment we could see in 2023.
Just real quick here, to end where we began, there is a question of whether there is this fiscal response to what people expect to be a downturn in 2023. Do you think that there is a political will to put more money into the economy despite concerns about inflation, even as soon as next year?
No, I think that the interesting thing over the last 3 years was arguably since the first time since the financial crisis, there was actually some level of coordination between the fiscal and monetary side. Oftentimes, the monetary response was because the fiscal side was so dysfunctional. I think we returned to some of that fiscal kind of brinkmanship on the debt limit, on entitlement spending. And I think I would add to that is a conversation about how much leeway does the Fed have on monetary policy side, is that you're starting to see a bipartisan group questioning the powers of the Fed. Why do they have this much power? Is the political window for the Fed to raise rates without a significant backlash to their future power closing on the Hill, Lisa? And that's what I'd be focused on as it relates to kind of when does the Fed kind of hit that terminal rate, because they don't want to lose their power after the 2024 election if they get this kind of deflation or disinflation kind of push wrong.
Ed Mills of Raymond James, thank you so much, and a great point to end, especially given that unemployment rate, Kailey, hasn't yet increased. So wait for that to happen before you start worrying about the political credibility of the Federal Reserve.
Yeah, and it raises the question, we know the politics of inflation are hard. The politics of a hurting economy and higher unemployment going to be very, very difficult as well as we get closer to 2024.
We're not there yet. We are, though, seeing a bit of softness to end a brutal year for those long equities, down almost 0.4%, 38.58 to wrap up 2022. This is Bloomberg. Nine and a half hours. That's how much is left in the last trading day in the United States for 2022. This is Bloomberg Surveillance alongside Kailey Leinz and Matt Miller. I'm Lisa Abramowicz, taking a look at a tepid day. A lot of people probably are on vacation and already celebrating the end to the worst year of losses going back more than a decade. Joining us now to give us an overview and a state of play for where we are right now. Kriti Gupta is taking a look at markets. Kriti.
Yeah, Lisa, I'm sure a lot of traders have signed off and are not looking back after the carnage of this year, and today might not be any exception. You are seeing a little bit of red on the screen when you look at the stock market on both sides of the Atlantic. By the way, futures are down about 0.3%. NASDAQ 100 futures down about 0.4%. Go across the Atlantic, the stock 600, and you're seeing a little bit more pain there, down 0.6%. But what's something that was really striking to me is that overnight, Asia actually performed in the green. They performed positively. So you are seeing that regional divergence, which brings me to a little bit of a zoom out. It is the last trading day of the year, so therefore it is a day of reflection, Lisa. This idea in the last 5 years, really in the last 2, you've seen this kind of complete move in sync around the world when it comes to equities. 2 years ago, 2018 to 2020, that was not the case. U.S. outperformance was 100% the story. And now, if you actually start to zoom really closely into what the case has been in the last, I want to say 2 or 3 months, U.S. outperformance is once again becoming the story. So I do wonder how much of that really translates into 2023, but it will probably be a function of what the cross-asset markets are doing, which means we should probably get a check on them this morning. The bond market, once again, not doing a whole lot. The 10-year yield at 3.85, yields up only about 3 basis points. Take a look at the dollar, actually weaker a little bit, not following the trend of yields, which I think is an interesting story, down about 0.3%. Most of that action a function of what's going on with the BOJ and the Japanese yen. And of course, we have to look at the Bloomberg Commodity Index. Nothing to write home about, really just unchanged. But once again, in the new year, that could be the game changer for a lot of the equity market.
Kriti Gupta, thank you so much. I'm really glad you talked about the U.S. outperformance, because a lot of people are thinking heading into 2023 that will reverse and that we actually could see, Matt, Europe outperforming. And I say this as someone who has spent a lot of time in Germany, the epicenter of the crisis that maybe wasn't as bad as people had expected.
Right, and Europe never outperforms.
No, exactly. It's the Widowmaker trade.
It's perpetually undervalued. Yeah, I think it's really interesting. Barbara Ann Bernard, founder and CEO of Windcrest Capital, joins us to talk about this. And I have always thought in times of crisis, Barbara, that investors would turn inward, only investing in the U.S. because things that are far away are scary. Did that happen at the end of this year? Do you not expect that at the beginning of next year?
I think that's happened for the last decade, Matt, and I think you're absolutely right. But what's different today is it's at an all-time high. If you take the MSCI All Country World Index, and that's a market cap weighted index, the U.S. comprises 69.7% of it. If you reweight the same index by GDP, the U.S. would be 20.5%. So what that tells me is investors are ignoring all of these wonderful bargains outside of the U.S. And I have this view that things can be very popular or very, but not safe, right? And so the U.S. is popular, but I don't think it's safe because it's expensive. So we find literally half the multiple, twice the growth outside of the U.S. And so for me, I feel safer investing outside of the U.S. right now, and we're actually net short the U.S.
All right, net short the U.S., even though we're looking at 7% earnings growth? Or do you think that that's an overestimation by analysts because everyone is saying that there's going to be a recession at the same time?
Exactly. So consensus is at the index level is saying we're going to have an earnings recession next year, yet the analysts are still calling for 7% growth, as you say. So on back of that, you've got the S&P at a 17 times multiple, which is above the historical average of 15 times. And to me, that's completely unjustified. So I think what happens is in Q1 is companies come out and they kitchen sink 2023. And they didn't have to deal with 2023 until now. And this is I think they'll get realistic. So I think you'll have multiple compression and you're having EPS compression. And so that makes me nervous about the US market.
Although some people would argue that the U.S. is in the best position, particularly for the transition of certain businesses in the technology world with the onset of the Inflation Reduction Act come next month. How much does that factor into your view? How do you push away some of the speculation that will actually draw talent and business to the U.S. away from Europe, away from other potential major economies?
I don't want to detract from that at all. I mean, the U.S. is an engine of innovation, and that served it very well. What I think is a little different now is a higher cost of capital changes the businesses that get underwritten. And so this idea of winner take all, which absolutely worked for the last decade, I don't think works for the next decade. Peter Drucker has this quote, and I love it. He says, the heroes of the boom are the villains of the bust. And if you look at some of the worst performers this year, it's your Amazon, it's your Teslas, it was the darlings of the last decade. And so what I see is this regime shift. And that's where I get excited about the types. We're going to redefine what makes a good business model. And if your business model is contingent upon cheap capital, I don't want to go anywhere near it.
So which regions are you looking at in particular? Or is there a type of business? Is it Europe? Is it China with the reopening there? Or is it Japan, which is just seems to be emerging maybe perhaps from what has been a lost era?
So it's so interesting. If you want to make alpha, right, generate alpha, you have to be contrarian, but you also have to be right. The name of my hedge fund is Contraria, and as one of my investors pointed out, he's like, that's the stupidest name ever. I don't need you to be contrarian. I need you to be right. So what's contrarian and where can we be right? I'm actually not a fan of Japanese equities because I don't think a higher yen is good for the exporters. So I think I'm probably a little contrarian right there. I do like China. I like Indonesia, and I like Africa. India has been very good to us this year, but I think it was a beneficiary of China essentially being uninvestable because of the COVID lockdowns and because of the regime changes that they put in place, over the last 2 years. So I think this year money flows out of India back into China. And the reason I like EM is inflation is lower, growth rates are higher, institutional investors are not there. And as a result, they've lacked research coverage, which creates opportunity for people who really want to sharpen their pencils and do the work. So for active managers.
And I would imagine for emerging markets as well, the fact that the dollar's peak seems to have been firmly in, and we're looking at a dollar now at its weakest level since June, is a big factor in that too.
Absolutely. And that's when emerging markets started to take off, right? Peak dollar. And so that's good for commodities and it's good for emerging markets, and we're long both.
On the point of commodities and you being long them, we were talking earlier about the fact that we were, for a good portion of this year, talking about triple-digit oil prices. And we have essentially made a round trip. You're going to have a very modest gain for oil this year, and you haven't even seen the benefit of the reopening of China reflected in that market. To what extent is that actually going to kick in, or are we looking at a trade that is now pretty exhausted?
Oil's a tricky one. China reopening, I guess, is stimulative for oil prices, but against a backdrop of a slower global growth. And then you have OPEC kind of controlling, pulling strings in the background. So I'm not an oil expert. The commodities that I prefer to focus on are ones with these huge tailwinds. So the green energy transition metals. And I don't have to go to emerging markets for that exposure. I can find companies like Solaris in Canada that are trading at 10 cents on the dollar per my NAV calculation, or Foran, which is the world's first green copper miner, also in Canada, which is completely de-risked from a funding perspective, but has all of the tailwinds of the energy transition. And the reason I like that is the copper intensity of the energy transition, I think, makes up for any doubts I would have about depressed copper demand because of slower global growth. So it's a tricky year in 2023, but I think there are going to be lots of opportunities for active managers.
Barbara, the phrase of the year for me has been tax loss harvesting. I started hearing it at the beginning of the summer, and it's been increasingly used as we get to the end of the year, obviously, for obvious reasons. But if everyone's expecting a recession, right, and investors are managing to harvest some tax losses at the end of 2022, do we get a Q1 where executives say, all right, there's already expectations that are so low, I'm going to throw everything into this quarter. Then you have the bottom there, and investors who sold out for tax loss purposes at the end of 2022 can buy in to stocks they were convicted on in 2023. Does that make sense?
It makes perfect sense to me, Matt. I mean, I'm actually constructive about 2023. I think I can't wait to take the shorts off, but I think Q1 will be lumpy and bumpy, and I think China's reopening is not going to go as smoothly as people think. And so, even though China's had this huge run, I think there will be a pullback, and that'll be another opportunity to get long for the long run. But absolutely, I think Q1 is the kitchen sink, and then we reset expectations, and we can normalize from there.
Just real quick here,
So
Barbara.
a year of two halves.
To finish up on the point that you were making about active management, how this is going to be the year of active management, you say that it's the ultimate anti-bubble because of how much people have withdrawn from that in favor of indexing. Do you find
Absolutely.
that clients are willing to pay for active management in the same way that they were, say, 2 decades ago?
I think I think 2022 is going to change that conversation. You look at the NASDAQ down 33%. You look at the S&P down 20%. You look at a fund like mine that's flat. For 1%, you could have saved 25% of your entire investment. And so the 2022 is about just conserve capital. Because if you're down 25%, you have to be up 33% just to break even again. So the losers don't compound well. And active management is about active risk management. If you're an active manager, you can short, you can raise cash, which we did. Now you can go into these unloved markets, which is what my mentor, Sir John Templeton, always did. So there's always something to do if you're willing to trade away from the crowd and say, what is the opportunity? What is the opportunity that higher rates give me?
Right.
What it gave us was the ability to short consumers and, stories all over, housing, car retailers, housing stock. So that was a wonderful opportunity. We didn't see it as a negative. And so, but for the last 10 years, you didn't have to. It was just, the big got bigger. And I think free money made that happen. And that game is over. So this is back to the future in terms of analyzing companies on the basis of cash flow, not eyeballs, not market share, and things that are sustainable in terms of self-financing. And this is healthy. This is a good thing.
Barbara Ann Bernard of Windcrest Capital, thank you so much for that. A lot of people have been talking about how it will be the year of active management. We've been hearing that for a while, of course, Kailey. But this time they say it is different, especially because you did see the index underperform so dramatically some of the particular sectors and a real divergence there.
Yeah. So maybe this time is different for a multitude of reasons. And we have seen, and we made this point yesterday, bottom up, you got it more right than you did top down. And I think that's an important point for this year.
Coming up, we speak with Justin Hugendorn, head of fixed income strategy at Hilltop Securities, talking about the fixed income picture and how that perhaps plays in to this idea of active management as well. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After a week-long meltdown, Southwest Airlines plans to return to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It's been difficult to obtain accurate data since the COVID-0 policy was lifted. Some tense moments over the South China Sea. A Chinese fighter jet flew within 20 feet of a U.S. Air Force reconnaissance plane. The U.S. military says the American plane had to take evasive maneuvers to avoid a collision. China asserts rights to more than 80% of the South China Sea. In the Bahamas, authorities say they seized $3.5 billion worth of digital assets at FTX shortly after the crypto exchange filed for bankruptcy protection. The Bahamas Securities Commission cited a risk of, quote, imminent dissipation of the assets. That was based on information provided by founder Sam Bankman-Fried. And he was called the King and has long been regarded as the best soccer player ever produced. Brazilian star Pelé died Thursday after a battle with cancer. Pelé led Brazil to 3 World Cup championships. Later in his career, he moved to the U.S. to play for the New York Cosmos, fueling new interest in soccer by Americans. Pelé was 82. Global news, 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
I agree that there needs to be clear federal oversight here to really protect consumers, and at the same time to be able to provide clarity for the industry to operate in the country. I'm going to be here for the long term. I have no plans to leave. That is not something that is on my horizon.
Well, it perhaps wasn't on its horizon, but it happened anyway. That was Sam Bankman-Fried, FTX co-founder and former chief executive officers, speaking to my current co-hosts, Kailey Leinz and Matt Miller, right now, back on September 27th, before his company went bankrupt and he was arrested in the Bahamas, and now is being tried and potentially could be jailed for more than a century. This story has fascinated me endlessly, from both a psychological perspective as well as a question mark around the whole industry that both of you cover so intimately. Matt, I know you've been a huge Bitcoin enthusiast. You've seen a lot of people stick to their guns when it comes to a lot of the crypto assets that have had staying power, especially through all of this turmoil. Where do you see some signs of doubt creeping in that perhaps this was a byproduct, or aspects of this market were a byproduct of the free money era?
I mean, I don't think you can completely disentangle the collapse of FTX from the underlying tokens, from crypto, the industry. However, what's been alleged here, and I don't know exactly what happened, seems like your average run-of-the-mill fraud that could have happened 100 years ago with a completely different asset. So I don't know how connected it is to Bitcoin. The fascinating thing to me is that this guy is clearly so intelligent, right? His parents are clearly incredibly intelligent, Stanford law professors. And yet, he managed to lose billions and billions of dollars.
But his intelligence isn't in question here, right? And this isn't a matter of
intellectual prowess. But he should have been pretty good at math, right?
Well, right. So it was not a financial oopsie.
Right.
I think we can all believe
right.
that.
So this is the reason why people are alleging fraud. But there's, I mean, again, I just keep going back, Kailey, to the larger question, which is this something endemic in an upstart asset class that doesn't have the same kind of regulation, that hasn't been necessarily labeled as security in the same kind of way, and where there are people who are trying to innovate, and innovation can be conflated with out-and-out fraud?
Well, this is the question we have continually raised in the aftermath of this episode. If regulation had been able to keep up with this industry, would it have been preventing something like this from happening?
Regulators say no.
Exactly, because at the end of the day, if this was just about someone moving money around in ways that they should not have, and just poor
That's already
corporate
illegal,
controls,
right? There are regulations against theft.
Right. So it raises a question of how much this is just an industry that is moving too quickly for anyone to catch up to, and how much of this is just a bad actor at a certain level. The other thing I will say is the lack of due diligence on the part of more traditional players in venture, and people who backed him, and us in the media as well. Matt and I conducted that interview with Sam Bankman-Fried, 2 months before all of this came crashing down. So there's a level of just feeling like it's opaque.
It did cross my mind to say, why are you in the Bahamas? If you're such a champion of regulation and the law, why are you offshore?
Well, it's a fair point. And Kailey, the fact that you mentioned venture capitalists, and you mentioned some pretty big investment firms, including massive pensions that had invested in this, again, and not to be extremist here, but it raises a question about what else was not sufficiently sort of cross-examined before invested in. You know, I mean, again, how much are we seeing the outgrowth, the ramifications of the free money era and venture capitalists who just had more greed than they did
If Sequoia bought this, like, what else have they bought?
Exactly.
You know?
And what about the other companies and the valuations? And I think about Elon Musk and how much he bought Twitter for, and I think about other sort of asset classes. Exactly.
Remember those? Yeah, no, and this is a really interesting conversation to have with Ed Ludlow as well, who covers all of these different parts of the technology world. He is in London at the moment. Ed, how much of this is, as Lisa says, a symptom of money no longer being free? And how much of it, at least for crypto, is because of these individual seismic collapses of different projects and exchanges and massive players?
Well, I think to your point that you guys were just discussing, we had loads of venture capitalists on the show, right, just to address that one point really quickly, who did invest in FTX, or even some entities in the world of crypto that received money from FTX. And they all say the same thing, that he was incredibly impressive, his PowerPoints were sort of solid and airtight. Prima facie, he was legit. We will discover in due course if the allegations against him are true, and he just, was simple defrauding. Really important story out of the Bahamas in the last 24 hours that the Bahamian Securities Commission has seized $3.5 billion of assets from FTX Digital Markets, which is interesting because it's the Bahamian registered entity. And the reason that that's so important in this story, guys, is we're still trying to find out where the holes are, where the money's gone, where the assets have gone. And remember that John J. Ray, when he was in front of when he was in front of Congress, said, actually, I'm really worried about this situation because I don't think that international customers will get their money back. The US might, but this $3.5 billion does relate to that international business.
Ed, it's a fascinating story, specific unto itself, but I do have to broaden out, especially with your expertise in the tech industry.
Sure.
Kailey was just talking about venture capital and the other investments that were made, particularly in the tech space. We've seen a 35% decline in the NASDAQ 100.
Yeah.
Do we have a sense of the scope of losses within tech venture capital as some of the new investments in the private companies that perhaps have not been fully marked down yet?
Yeah, it's really interesting. I heard Matt talking about how you can't unentangle the story with crypto this year, whether that be digital assets or crypto-related stocks or VC-backed firms that are operating in the underlying technology. The fact of the matter is that we started this year, January of 2022, with the global market value of all digital assets at $2.5 trillion. And we've been so focused on SBF and FTX in the last 2 months, we lose sight that we'd already dropped from $2.5 trillion in value to $1 trillion by June of this year. Think about all the other things that happened, the collapse of Terra USD, the SEC opening an investigation into Binance, well before FTX filed for bankruptcy, well before Binance came out and said that they had some concerns about FTX. It's been a very volatile year, and a part of the story has been directly linked to the Fed, and the path to higher rates, because no matter what the debate, well, there is a debate, about Bitcoin's role as an inflation hedge, the volatility we saw in equity markets and the pullback we saw in capital deployment, the private markets, that was part of the story. It's just that in that very narrow window at the end of the year, we just kept going to this 2-year low on Bitcoin where we've stayed.
Ed, what I find amazing about the FTX story, well, first of all, on Bitcoin, the stability has been unreal, right? Right. It just hasn't moved from where it came down to on November 7th. The whole story, though, the most fascinating issue in terms of the company to me is that there just weren't records kept, or at least John J. Ray III can't find them, right? And we still have yet to get even kind of a back-of-the-napkin accounting on assets and liabilities. You've got $3.5 billion, apparently, the Bahamas. They had an 8% stake, we know, in Robinhood. 370-some million were stolen. But no one has said, okay, there's roughly $5 billion in assets and $9 billion in liabilities, even after 8 weeks of the most skilled experts in the world going over these books.
You and I have been discussing this off camera for weeks, but also this morning. Bloomberg's done some great reporting around this, right? Remember, it was Zeke Faux who flew to the Bahamas, spent time with SBF in the living room, the famous living room, and SBF got a spreadsheet out, and they went through it together, the Bloomberg reporter, Zeke Faux, and SBF. And they identified together in that process what we believe to be $8 billion in missing from the balance sheet of FTX, liabilities that FTX is unable to recover. The other piece of data that I shared with you, Matt, is that the CFTC's most recent filing, which stated that by approximately mid-2022, mid this year, FTX's internal ledgers reflected that the balance of Alameda's fiat liability to FTX totaled $8 billion. It's hard to know the relationship between those two $8 billion sums, but a lot of forensic work is going to have to be done as part of this legal proceeding against FTX. Good time to be a forensic accountant, I suppose.
Ed Ludlow, perhaps, although perhaps it's someone's nightmare if they actually believe in accounting and keeping track of things. Ed Ludlow, thank you so much, as always, for joining us and laying that out. And really, it is a fascinating story. It is more than that. It's deeply painful for people who have lost billions of dollars, especially given what this was invested in. I mean, honestly, again, talk about the lack of accounting. Yes, it was invested in tokens, as you were pointing out, Kailey, with an arbitrary value that potentially would be tanked if they sold it, but also Robinhood. He actually borrowed against this to make a significant stake, Matt, in Robinhood.
Yeah, I think, well, Robinhood is something that has, I think, intrinsic value. It's harder to pin that down when you're talking about cryptocurrencies. On the other hand, who leaves this much money on the exchange? The whole point is trustless, money. You should keep your own private key.
This is Bloomberg.
Now going into next year, everyone is bearish, right? And we're going to have this massive recession.
It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers and may roll through some of the other sectors in the economy.
Even if we see growth hold up okay, we don't fall into a recession.
We've never had a recession without the claims data going up.
We're expecting a mild recession, but we don't think that it's going to last long.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's almost over. We can actually say that. The worst year for stocks and bonds in more than a decade. Good morning from New York City, the last trading day of 2022 for our audience worldwide on Bloomberg Television and Bloomberg Radio. This is Bloomberg Surveillance. Take a deep breath. John and Tom are taking a deep breath off today. I am so lucky to have Matt Miller and Kailey Leinz in the seat today. I'm glad you sigh because that's what it feels like. Although, what are we heading into? I mean, it's not like you can necessarily get a real break in terms of some of the trend lines that caused this carnage.
I'm excited.
Return level.
You know?
Okay.
Fish tonight. And then
that's
the big
still in
games
2022.
Tomorrow.
Matt.
Yeah, no, I'm kidding. I think. Look, it's been a horrible year. Obviously, if you are long or if you were long, but there are so many opportunities that come after big drops. Right? Look what happened in March of 2020. I distinctly remember being on the phone with my mother, who was in tears about her 401k. And yet, just a few weeks later, we bounced all the way back.
Okay, but the difference, and this is the main distinction, the Fed was the put. The Fed was the driver. There still was free money. There was still this non-inflationary environment. We have seen regime change in 2022, Kailey. This has been the year of inflation that we have not seen for 4 decades. This has been the year of generational increases in rates by the Federal Reserve and central banks around the world. Does that shift back to the normal of 2020 when your mother was crying, Matt? Or does this, Kailey, lead to a new era of higher inflation and lower returns certainly for stocks?
Yeah. Is this the start of a world in which we never see the zero bound again and money is no longer free? I mean, Matt, you talk about how we saw that massive rebound. To Lisa's point, you had not just the monetary policy backing, you had a fiscal backing as well. And if both of those forces
fiscal
go away,
backing of all time,
record-breaking fiscal stimulus, and granted, you could talk about how that contributed to the inflation problem we're now grappling with. But if you don't have either of those backstops, if we do indeed see a global recession in 2023, what force is going to bring us out of that?
About 3 weeks ago, I remember we were talking with different analysts, and they were saying, the biggest variables for next year are the reopening of China and whether or not the Bank of Japan loosens up on their yield curve control. Well, we got ahead of ourselves because we saw China completely release zero COVID, and we actually are starting to see economic activity rebound in some of the major cities. At what point, Matt, can we take a look at that? Can we take a look at the Bank of Japan that's buying a record amount of bonds to try to keep a higher peg in place for maybe a time when they release it? At what point will that create a new scenario that has not fully been priced in yet?
First of all, I've been waiting an hour and 2 minutes for you to bring up the Bank of Japan.
Well, here you go. Happy birthday and happy fish concert.
Well, no, I mean, I think one of the most exciting central bank narratives that we've had this year, including the Fed in its 450 basis points of hiking, I think the interesting argument for 2023 is, you mentioned the end of the Fed put, and Kailey's saying, what's there to backstop us? Well, maybe the Fed put could come back. It's not necessarily dead. We were talking about Sir John Templeton earlier, and he said the 4 most dangerous words in the English language are, this time is different. On the other hand, we've heard some pretty big investment celebrities like Howard Marks, for example, in the Financial Times, writing that this is a sea change. Mm-hmm. This is, Howard Marks says, one of 3 times in his life when things completely are different. The first being, the Michael Milken junk bonds era. The second being the low rates, Alan Greenspan era. And now this, back to, higher rates. That's pretty impressive if that's the case.
Right now we're looking at markets that are still reeling, though. And we have not seen any kind of capitulation in terms of seeing a brighter future over the past, certainly, couple of trading sessions. Right now, we're seeing stocks lower about 0.4%. You can see 38.56, despite some of the calls to end above 5,000 by some of the stock bulls. At the end of 2021, you could see a bit of dollar weakness. I do wonder how much this is because of yen strength in Japan, how much this is yuan strength from China. This is Asia kind of recovering and loosening up some policies, perhaps, is driving some of this. 10-year yields ending the year 385. considering that they started the year at 150 gives you a sense of how far we've come. It's even more dramatic when you look at the 2-year yield. And crude, $78.34, a real sort of shocking departure from what some people were expecting at the middle of this year during the peak of the conflict with Russia invading Ukraine. People calling for $120 crude. Not so much. Heading into a tumultuous year next year, Dana Dioria, co-CIO at Envestnet, joins us right now. We're so pleased to have you. Congratulations, almost making it through. I want to start with one sector that got particularly beaten up, which was technology. And we have seen the NASDAQ 100 lose 35% and some of the components lose even more. This is the one dividing factor. Is this opportunity or is this more risk?
Yeah, it's a great place to start. It's interesting what's happened with tech. You look now and, risk on days, tech seems to do well and risk off days otherwise. But think back just even, to the beginning of this year and tech was sort of defensive. Tech had become, and last year, right, when we were looking at the pandemic, it was like, wow, tech is the place to be. That's the defensive posture. We've come a long way. And as you say, it's interest rates, right? It's what has happened over the course of this year, going from a free money posture to now we're back to return to fundamentals where there is a cost of capital. That's not going away, right? Even if the Fed does ease at some point next year and potentially even pivot, depending on how things go, money will still have cost to it. And I think that is a key point to understand about tech, because tech, of course, and growth in general has a lot of its value in the terminal value, and that gets discounted back by these higher rates now. So there's certainly an argument from my perspective. I wouldn't say don't go there, but there's definitely an argument from my perspective that expecting these highs again that we were seeing where, 22% of the S&P 500 in the top 4 stocks, I don't think we're returning to those days.
So if we're, if this time really is different from what we know of the kind of FANG decade, what else changes? For example, the U.S. domination in stocks. Barbara Ann Bernard earlier was saying she thinks that may be over for now, and at least she thinks there's real opportunity in Europe.
I agree. Look, I mean, markets are cyclical, right? And timing this perfectly, of course, is notoriously difficult. But if you think back the 10 years before this one, it was a lost decade for U.S. stocks, right? We all have recency bias. So a lot of our clients sort of have these portfolios tilted to U.S. and these questions come up after 10 years of, hey, should I even be in international markets? The answer is yes. You should be diversified in international markets. Unless you're somebody who's just so attached to your tracking error to the S&P 500, you can't tolerate that. And the reason, there are a lot of reasons for it. One is valuations, of course, overseas. One is the fact that, again, markets are cyclical. We've just went through a long period of U.S. dominance. But we also have changing economic fundamentals, right? We have deglobalization pressures, energy pressures, and pinpointing exactly who's going to be hurt the most by these things is a difficult thing to do. Your antidote for that sort of risk is to have your money spread across. I'll say one last thing. Dollar strength this year has been driving, a lot of the U.S. outperformance as well. Now, while I don't expect the dollar to collapse, I don't expect it to be as strong next year. I think as the dollar weakens and depreciates a bit in 2023, that also helps international.
What about China within international, especially as you were discussing deglobalization, Dana?
Yeah, China is such a push and pull, right? Obviously, you have, Xi now is potentially for life over there. And so what are the policies going to be? We saw, of course, the crackdown on the property sector. We saw a zero COVID policy. Now we've seen pretty much a reversal of those things, right? So out with the zero COVID to the extent where you now have countries looking at limiting Chinese passengers on flights. And, that reversal suggests that China reopens next year, could be a huge force, definitely a place to be. My caution there would be, yes, you want to be there as you want to be in any economy, because predicting where that's going to go is difficult. But I would hedge my bets there. I would have a cap, right? You think about the weight that China was in the emerging index. That's a very high weight for the portfolio. I would think to, maybe cap that.
Just quickly here, since you don't think that big tech is going to return to the same kind of era, what will be the leadership of the equity market when it does resurrect itself?
Yeah, so short term, I mean, the traditional advice is to go for defensive sectors, something like consumer staples. Everybody still has to buy these things, notwithstanding that, the inflation has made that more painful. Those are the types of sectors that you would go in a defensive. I think another interesting one to think about, though, is energy. And just where we're going to be in the next 5 to 10 years as we transition our energy profile. It actually, ironically, because you have less fossil fuel, digging new wells, et cetera, the prices there can go up, and that ultimately comes back to higher profits for the time being. So energy, I think, is an interesting place to look as well.
Dana Dioria of InvestNet, thank you so much. Have a wonderful new year. See you on the other side of what has been very difficult. I do think it's an interesting question, though, what it will be the leadership, because people talk about energy because of the lack of investment, Kailey. People say, okay, tech might not lead, but is there enough in the index to bring it up to the same levels that we saw if tech does not participate?
Well, especially when you think about the fact that, yes, tech has lost some weight this year, but it's still 25% of the S&P 500. The energy index is 5%. So that is not enough to carry the broader market higher, even if it does well.
But it's a huge piece of the stock 600, right? That's the idea. Over the last 6 years, every time I would ask somebody, why is Europe underperforming? They would always say, because it's all about tech. Europe doesn't have the Facebooks, the Alphabets, the Microsofts, the Amazons. But Europe does have the Royal Dutch Shells, right? Europe does have the British Petroleums.
Energy is still only 6% of the stock 600.
And you could argue that there also are policies in Europe with respect to windfall taxes, with respect to even nationalizing certain energy companies. If you take a look at Germany and what's happened there, would also create headwinds to the valuations of some of these energy companies. I just wonder how much we're looking at a new regime, because big tech didn't just mean investment in big tech. You saw those investments percolate into other industries as well. And you have to wonder what else retrenches if big tech doesn't
it's a good point. Actually, yesterday we were talking about the job situation with regard to the tech layoffs. And I said, well, where are they going to go? And a viewer wrote in and said, hey, they can go anywhere right now. Because you know what? They could work in autos. That's tech now.
Exactly. You could work at a bank. You could work in autos. How much are people going to try to bring up their technology, particularly at Southwest Airlines, which might be looking for some people to recast their entire system? Right now, we're looking at a market down 0.4%, 38.55 to end a tumultuous 2022. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over political and economic impact of Russia's struggling invasion of Ukraine. The U.S. may give Ukraine's ground fighting capabilities a boost. Bloomberg's learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25-millimeter gun. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was a push to influence crypto policy and build connections before FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. In the UK, a new poll shows the size of the challenge facing Prime Minister Rishi Sunak and his Conservative Party. The survey conducted by People Polling shows that Labour has a 26-point lead over the Conservatives. The next election is expected to be held in 2024. And in Canada, the merger court has cleared the way for the union of 2 of the country's biggest telecom firms. The Competition Tribunal ruled in favor of Rogers Communications' $14.8 billion deal with Shaw Communications. Now, the ruling said the federal antitrust commissioner failed to prove the merger would cause significant harm to competition. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think what's really interesting about this market, it is so emotionally based and fueled right now, right? Like you don't have investors actually looking at fundamentals and bottom-up analysis as much as they used to. So many investors were just wrong about what was going to happen in 2022 and they were overly bullish and things like that. Now going into next year, everyone is bearish, right? And we're going to have this massive recession.
Will it be the year of the bear? This was certainly the year of the bear. Will it continue next year? Some people saying perhaps it'll be the year of the rebound. It's certainly in the second half. That was Sylvia Jablonski, Defiance ETF's Chief Executive Officer and Chief Investment Officer. And despite some of the optimism that we've been hearing from a number of people, right now, I just got a note from Torsten Slok over at Apollo, and he was saying the consensus sees a 90% probability of recession in the UK, 80% in Europe, and 65% in the US. And it has been rising. And this continues to point to lower rates on the long end. Kailey, this to me is the interesting thing. You have a growing number of people saying the data doesn't suggest recession.
Yes.
And yet a growing number of strategists saying it is likely.
Well, it's a question of when the lagged effects actually kick in and how bad ultimately it gets. Because right now, I guess, the data is holding up. But we have seen such a rapid pace of tightening, 425 basis points in the span of 9 months. The economy hasn't fully felt the effects of that. So I guess if you are on team recession, you're saying just wait until it hits, guys.
And that would really bring back the idea of credibility for the Fed, right? That they can essentially shoot down inflation, which brings us to our next guest, an esteemed member of the Bloomberg Executive Team, Editor-in-Chief Emeritus for Bloomberg, Matt Winkler. You wrote a column that is fascinating, where you basically push back against all the people who are saying the Fed is just behind the curve. They're getting it wrong, saying actually it seems like they're bang on target.
Well, thank you. Great to be with you. Happy New Year. A year ago at this time, the prevailing narrative, as you say, was the Fed was behind the curve. Now, let's just go back and remember that 2021, inflation was 7%. And that's what prompted the outcry. And we also need to be reminded of the fact that the U.S. was making the most dramatic recovery from the pandemic recession, which was the worst since the global depression 8 decades ago. And we were getting close to what is now the 3.7% unemployment rate. So the U.S. economy was actually doing very well, better than any major developed economy in the world. And that's when the Fed decided, okay, the data is what drives us. We're data dependent. We're now going to tighten credit. And everybody said they were too late, too little, et cetera. And we know that. What happened, as you said, an unprecedented tightening, but a tightening that came when the U.S. economy was much stronger, resilient, than it otherwise would have been. And I think that's the parenthetical clause that's left out of this, is that the U.S. economy was much stronger when the Fed tightened. And so here we are today. Inflation is way below the 9.1% peak in June when everybody said the Fed had lost its way. The bond market never gave up on the Fed. The bond market was always confident somehow, some way, this inflation problem is going to be resolved.
Well, but the bond market got the Fed wrong at the end of 2021, right? Because we looked at a 2-year yield that was 0.7%. We looked at a 10-year yield at 1.5%. We saw a massive rise. People underestimated how much the Fed would have to do in order to combat inflation. Heading into 2023, how much credibility do you give the idea that we're in a new higher inflation regime that will cause a real question mark for the Fed in terms of how far they have to go and how much pain they have to inflict?
I'm not sure the bond market actually ever lost its way here. We're talking about maybe relative values, but the bond market was never convinced that runaway inflation was here, ever. And that appears to be still correct, okay? What the bond market, if you say, got wrong is it didn't expect the Fed to tighten to the extent that it did to contain inflation, but the bond market always anticipated that inflation would be much lower than many of our strategists and pundits have predicted. And so that's where we are today. The Fed is still going to keep interest rates elevated. They've already said that. And so the bond market is anticipating that we're still going to see, 5-6% inflation in 6 months. But a year from now, it's going to be much closer to the 2% target.
We talked to Ed Yardeni yesterday, who was saying that you haven't really seen anything break. You've seen implosions here and there in crypto notably, but there hasn't been any contagion across the entire financial system. And he said, maybe this Fed has gotten it right. They're probably closer to a soft landing, and there's a chance that there's no landing at all. Do you think that we're starting to see a growing view that we could have a very short and shallow recession, or even not have a recession?
Okay, so here are a couple things. A year ago, we were all concerned about supply chain bottlenecks, if you recall. And the ships in the port of Los Angeles, the largest port, were backed up as far as the eye could see. Maybe 65 ships waiting to unload their cargoes. When we caught up with Gene Soroka, who's the executive director of the Port of Los Angeles just a month ago, the whole waterfront was blissfully free of any supply chain bottlenecks. So there's an example where common prevailing assumptions a year ago turned out to be the worst as far as it went.
Right.
And now it's gotten better. So it's very similar with the rest of the U.S. economy, which is everybody you can think of was worried about a recession in July.
And paying double the price for used cars, right? I mean, prices were, obviously, that's part of inflation, just off the charts. And now we're looking at that, in that market, used cars, I've seen it just collapse, right? We got data out of Spain, for example, today that shows inflation is coming down much faster than expected. Do we get closer to 2%? Are the break-evens right, you think, in a year?
Well, look, the bond market is a collection of everybody with the most at stake, if you want to think about it that way. So these are the people who have resources everywhere. They're betting their reputations and their fortunes, and they're all over the world. And treasuries are the most widely held security anywhere in the world and the most liquid. And that collectively is, as far as I'm concerned, the most, if you like, evidentiary way of looking at this equation, which is these people are saying somehow, some way, just as you said, Matt, the inflation that we've been seeing is not going to be runaway. It's going to decelerate in the months ahead. And by the way, the economy still ends 2022 up, not down, up.
Well, obviously, 2022 was a very hard year to predict, and so much has happened, including Elon Musk buying Twitter, which is another curveball that I don't think any of us saw coming. Back in April, another one of your great pieces was entitled "In Defense of Elon Musk's Managerial Excellence." Having seen now, 8 months later, what has happened to Tesla's stock, what has happened inside of Twitter since he took over, how, if at all, does your view change in hindsight?
Well, I never understood the Twitter debacle, if you want to call it that, from the beginning, and said so at the time. I think what's missing in the discussion of Tesla right now, which obviously has been the biggest casualty maybe of the tech industry, is that it's still valued more than Toyota. Okay, if you look at, and nobody mentions that, if you look at the market capitalization of Tesla today, having lost, 60-70% of its value in 2022, it's still, $350 billion in market cap? And, that's worth more than Toyota. So it's worth still after all this carnage. Now, why is that? I would say partly because the automobile itself is way ahead of where the rest of the auto industry has been. It is by far in the U.S. the most popular EV still. And, that's the reality at the moment.
Even if you add General Motors' market cap to Ford's market cap to Toyota's market cap, Tesla is still worth substantially more.
Yeah. And so, okay, maybe that's all a mirage. But given all the carnage that we've all been talking about, I just think it's interesting. No one mentions that the market cap of Tesla today, at the end of 22, is still worth more than Toyota.
Matt Winkler, fabulous to have you on with your perspective. Matt Winkler, editor emeritus of Bloomberg, editor-in-chief emeritus, coming to us with some really great perspective. Really interesting to point out, Kailey, how the valuation of Tesla, yes, it has sunk, but not that far.
I wonder how much of that is a product of it being overly inflated in the era of free money, though.
Well, perhaps, yes, but also the future. And people don't talk about that as much. We will be talking about that coming up. This is Bloomberg. The last trading day of 2022, and everyone is very excited about it. This is Bloomberg Surveillance live on TV and radio. Matt Miller, Kailey Leinz, Lisa Abramowicz, Tom and John are both off today. They will be back at the start of 2023. Looking at a year of carnage ending with a whimper. Bloomberg's Kriti Gupta taking a look. Kriti.
Yeah, Lisa, the carnage continues in today's pre-market action. You are seeing some red on the screen. The S&P 500 actually accelerating some of their losses when it comes to E-mini futures, down about 0.5%. It gets worse when you look at the tech sphere. NASDAQ 100 futures down about 0.8%. What's interesting, though, is that across the Atlantic, Stock 600 still where we left it about an hour ago, down about 0.6% and change. But I have to talk about the bond market, Lisa, because, of course, to your point, that's going to be a major story going into the next year. But I wanted to take a broader look at the 2s, 10s inversion specifically. We know it's been inverted for all of 2022. The question is by what margin? We're looking at negative 54 basis points this morning. But put this into some context, because if you're worried about 2023 and potentially 2024 being some sort of deja vu of the 80s, it's worth looking at this gauge, because we are at, like I said, negative 54 basis points. Compare this all the way back to the 1970s to 1980s, where you saw inversions of negative 200. Are we actually there yet? And if you are betting on a deeper recessionary story, then this metric actually has some ways to go. And you would perhaps see that same argument in the credit market, where spreads are still not at recessionary levels. So perhaps some ways to go. But let's bring it back to today's trade specifically, because the bond market not doing a whole lot like the stock market is either. The 10-year yield at 383, only higher by about 2 basis points when it comes to the yield. To me, I think the story is really in Asia today. And yes, there is a story, even though it is the last trading day of the year. Copper is actually outperforming the entire commodity index, and that really comes with the Chinese reopening story. More and more people looking to copper as the gauge for the global economy, not oil, which I think is interesting, up about 0.2% today. And of course, the dollar yen story, as the BOJ ramps up those bond purchases, the Japanese yen strengthens and straightens. We're looking at 131.86 on dollar yen, Lisa.
Kriti Gupta, thank you so much. And Matt, to your point earlier, you were waiting for us to talk about the Bank of Japan, ending the year really with the major Asian stories that people have been waiting for, coming well before people had expected them. This idea, the Bank of Japan is buying a record amount of JGBs this month alone, and yet the yen is strengthening because the market does not believe that it's actually going to go through with maintaining this, because it just seems unsustainable to continue with yield curve control.
Yeah, so I wanted to ask you about this. What does it mean that they've widened the band, right? So they've let the bonds float up to 50 basis points in yield, and yet they're spending so much money to keep them there. Does that mean they're not planning on widening it again? Because then why spend the money?
Well, basically, the theory is they don't want this to be an uncontrolled move. This isn't a market, right? These are bonds that have not traded. Where is the audience for this? So to the extent that anyone independent still owns JGBs, they're going to push against what the Bank of Japan is going to do, and they're going to demand the biggest premium that they possibly can, because why not? At a certain point, especially with the inflation target coming in above the target for the Japanese for several consecutive quarters, Kailey, you have to wonder, is this just the prelude?
And is this just a mess Kuroda is going to ultimately leave to his successor? Because he's out the door in April.
Yeah.
So
that would be so uncool, though, right?
Well, but that's actually one reason why people think that, because it's so uncool, that's the reason why people think that perhaps he'll do it earlier. This is one of the conversations that's percolating, certainly in the fixed income space, not only with respect to what happens in Japan, but also U.S. yields and how this could really trickle back, considering that Japanese buyers consist of a huge proportion of holders of U.S. Treasuries. Justin Hogendorn joining us now, head of fixed income strategy and analytics at Hilltop Securities. And I want to start there. How underappreciated, Justin, is the Bank of Japan's potential giving up of the yield curve control and the reopening of China and pushing long-end yields higher?
Yeah, I think that's a great question. And thanks so much for having me on the show today. But I think you were just talking about copper, and I think that the fact that copper's going up is a great sign. I think the fact that the Bank of Japan is pushing rates higher, that China's opening up, we are starting to see some good signs. So that's really good. But 2022, it was a ratchet year. I mean, it basically, what we're looking at is just, I like how you said it ended with a whimper. I just think, stocks down 18%, bonds had their worst year on record, with the Bloomberg Ag down 9.7%, the worst year ever for bonds, and the Bloomberg Ag was in 1994, where it was down 2.9%. So yeah, I think there's a number of trends around the world that we need to pay attention to. And 2022 was horrible, but I think there's better times coming for us.
Yeah, I mean, does that mean you get in on the bottom floor here, Justin? If you've had these huge declines, it's almost like there's nowhere to go but up. Certainly in fixed income, it feels that way. Is that too dangerous a bet to place right now?
No, I actually don't think it is. I believe that we are going to go into a recession in 2023, but I believe it was here but not yet. In other words, we felt like we had a recession in 2022. We even had the first 2 quarters of the year negative growth, but it really wasn't. It just couldn't keep up with inflation. Unemployment wasn't going up. And what I think we're going to see, it's going to be a little bit more painful for the common man than what they've experienced so far. In 2023, I think we are going to get that rising unemployment. I think we're going to get more negative quarters of growth. But from a financial markets perspective, I think we're going to see much better. I expect better for stocks. I expect it better for bonds and a number of others, even crypto. I think it's going to be better. But if you look at bonds, it's really, when you look at, okay, we probably had the low in municipals maybe that we would ever see. They lost 9.2%. Year to date in 2022. The worst year ever for munis, we're down 1.6%. But just about 4 weeks ago, municipals hit a cycle low.
Justin, you talk about pain that's going to be felt in the real economy with unemployment going higher, the common man struggling a bit more than they have. And yet you would talk about how there's going to be less pain in financial markets. So is that all predicated on the Fed reacting to that pain in the real economy? What happens if they do as they say they will and look through it?
I don't really. I think the Fed's got to talk tough, but I think the Fed's got a really soft heart. So they acted very tough, and they just demolished markets in 2022. They moved from 0.25% upper bound in the Fed funds rate to 4.5%. That's just bound to crush markets. But ultimately, they have a benevolent heart, meaning that they don't really want to see that pain. They knew they had to create that pain or else inflation would get out of control. Paul Volcker was the best one that knew the power of crushing inflation. And the sin, or as a former colleague of mine said, stop inflation now, of allowing it to keep going. And people learned that in the 70s and 80s. However, now, So
if you think it's mostly talk and not actually going to be walk from the Federal Reserve, what does that mean for their credibility going forward?
Well, I think they've earned it this year. I think they've earned incredible amounts of credibility. So I think they're going to keep doing whatever they need to do to make sure they earn that credibility. They're going to talk tough. They're not going to bend, but I think they're going to pause here fairly soon. I think they'll probably go 1, maybe 2 more hikes, and then they're going to pause. And if we do start getting a recession with rising unemployment, I think that's when they really start to turn the ship. But I think that's also when they can say, at least temporarily, they've beat inflation. And so but in the 70s, we saw a double sort of headed monster of inflation. I think it's different today. I don't think we'll see that. My base case is for that not to happen, but the Fed's got to be aware of it, and they're going to have to be on their game.
What about risk assets? Are we going to see some bigger sort of pitfalls, particularly in junk bonds, considering that people do see some sort of deterioration in the economy, and we haven't really seen it yet in spreads?
Yeah, I think corporate defaults is more like the common man. It's not like anticipating like the financial markets. What it's doing is, we've seen levels down significantly. If you look at the the Bloomberg Credit Index, it's down 16.5% just on a price return year to date. So these companies, and there's a lot of prices in the high yield market in the 30s and 40s, and when par is 100, that's not a good sign. And so really, we had unnaturally low default rates in 2020 and 21 due to the government support. Okay, so all money, the government was supporting businesses in its plans, and so essentially, right now we have that turning around. We've seen it in a number of sectors, even in the municipal market, such as senior living, that defaults have come up. I think better times will come because that's an important sector, but I think it's seen really tough times. I know you're going to have Yafa on the show later. She's going to probably talk more about that. But ultimately, I think like in the high yield credit market, we will probably see defaults. I know a lot of people are saying 2.5% to 3.5%. I'd actually go a little above that. I'd say 3 to 4% type of default rates in the high yield market. It's going to be tough. It's going to be tough for companies.
Tough for companies,
and
but perhaps
liquidity is drying up.
Tough for companies, but perhaps not a reprisal of 2008. Justin Hogendorn, thank you so much for being with us of Hilltop Securities. We do have a final number for 2022. Matt Miller.
Yeah, we're looking at a FTSE index because the UK and I believe Ireland have closed now. It's a half day as we go into the new year. Their full year figures are out, and the FTSE's up 1.2%. So it's a sea of red when you look across global indexes and how they ended the year. Right, we're down 20% right now on the S&P. About we're looking at drops of 12% on the DAX. The CAC is down 9%, but the FTSE is up year to date, which I think is really interesting.
Well, and it comes back to your point earlier about the energy exposure, because energy is the one area really in the equity world that has done well, and it is a much larger weighting in the UK benchmark. It's 13% of the FTSE 100.
This is going to be an ongoing rolling day of tallies as we try to get a sense of what has happened and the counterintuitive moves, because that is counterintuitive considering especially what they went through.
Well, but cable's off, right?
Leadership. Yeah, exactly. How much is this really a currency move? How much is this really, inflation adjusted? You talk about, if you inflation adjust some of the revenue streams, it looks pretty bad. But if you just look at it on a nominal level, you're actually getting a lot more money. So right now we are looking at with how much more do we have in the day? We've got about 8.5 hours left.
We're almost there.
The end of 2022. 2 p.m. close for bond markets. Coming up, we get the latest on COVID and the reopening in China. Lauren Sauer joining us from the University of Nebraska Medical Center. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, after a week-long meltdown, Southwest Airlines plans to return to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. It's being called one of the most intense missile and drone attacks in the war in Ukraine. The barrage rocked cities across the country, including the capital of Kyiv. Ukraine says it shot down 54 of the 69 cruise missiles. Still, it's likely that Ukraine will ask Western allies for more air defense systems. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It has been difficult to obtain accurate data since the COVID-0 policy was lifted. Some tense moments over the South China Sea. A Chinese fighter jet flew within 20 feet of a U.S. Air Force reconnaissance plane. The U.S. military says the American plane had to take evasive maneuvers to avoid a collision. China asserts rights to more than 80% of the South China Sea. And he was called the king and has long been regarded as the best player soccer has ever produced. Brazilian star Pelé died Thursday after a battle with cancer. Pelé led Brazil to 3 World Cup championships. Later in his career, he moved to the U.S. to play for the New York Cosmos, fueling new interest in soccer by Americans. Pelé was 82. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
If we see China really start to stimulate again, and it really depends on the flavor of that stimulus, if it looks more like infrastructure and the kind of old economy things they used to do, that could put upward pressure on commodity prices and thus kind of reintroduce the inflation risks into 2023 from a goods and commodity perspective.
Is China's reopening a tail risk or a tailwind? Cameron Dawson weighing in on the risk aspect, New Edge Wealth Chief Investment Officer. This has been one of the big questions, not only with respect to China and the economy, but also with respect to COVID. Do we have to care about coronavirus again? Do people have to start getting tested and wear masks? Lauren Sauer, I loved speaking with you. I saw your name pop up and I thought to myself, I really want to speak to you, and I hate that I have to speak to you, because why do we have the reprisal of COVID yet once again? Associate Professor at the University of Nebraska Medical Center and Special Pathogens Research Network Director. Lauren, it is great to see you. And it is also terrible to see you because people are starting to get worried about a new variant. How much are you concerned about this? How much is that tied to sort of the mass infection level that we're seeing in China?
Yeah, it's a great question, and agree. Happy to see you and sad to see you, because it means we're back to seeing large numbers of COVID. So I think for me, one of the biggest concerns is less that a new variant's emerging, and more about the just volume of cases that may be coming out of China. I mean, we've seen some numbers that look like the early days of COVID, when we weren't even calling it COVID, and we were watching from afar to see what would happen in China. So I think the numbers of cases are what we're worried about seeing come into Europe, come into the US, come into the global environment. And if we do see new variants emerge, I think it'll be important to track what they are, what the subvariants are, and make sure that we can adjust our tools.
Lauren, can China be trusted to reliably do that and to count the cases, period?
I think it's not what we're seeing right now, for sure. We're not seeing the data we would like to see out of China, especially on the deaths, on the sequencing that they're doing. So they've reduced the amount of people that they're even testing. So we're not seeing testing data, but we also know that the testing is much lower than it was just a few weeks ago. And so I think the pressure has to be on China to share every single number they have, right? So what are the case counts that they're aware of? What testing are they doing? And importantly, what variants are they seeing?
Is it only the variants that pose a risk to the rest of the world if we are worried about it spreading once again? If no new variants emerge, how much of the population is going to be relatively immune, or at least not have any form of severe disease, because we've already had so many infections and vaccinations as well?
Yeah, it's a great question. I think that large numbers of COVID are problematic and dangerous no matter what, because the more COVID cases you have, the more likely you are going to see those severe cases and the deaths. So no matter what, we are going to have large numbers of cases coming out of China and impacting the global health environment, the global economy, and that can be really dangerous. I think anytime you have a less immune population, you're going to see the potential for variants. So even if we're not seeing variants right now, seeing those large numbers come out could impact the likelihood that we see a new variant in the future.
Lauren, how does the U.S. situation look right now with regards to COVID infection rates, specifically New York City, around the Madison Square Garden area? Because I'm going there tonight with 20,000 of my closest friends.
Not a selfish question at all.
Yeah, I would definitely recommend wearing a mask in Madison Square Garden. I think COVID rates are still quite high, and we're seeing a lot of ILI or influenza-like illness all across the Northeast and really all across the U.S. So it is a risky time to be in close quarters with people, and we're seeing a lot of illness still. So I think there's a lot of people who are worried about an ongoing COVID surge, and it's coupled with a respiratory virus season like we have not seen in several years. So it's not the safest time to be out in public, certainly without a mask, but just in those close quarters.
Is it ever going to go away, Lauren? I mean, it's been almost 3 years, right? And now we're adding all of these other, you've got the respiratory infection. People are worried about flu and pneumonia. Again, I've had, I think, 6 shots since March of 2020. Are we ever going to get over this?
I don't think COVID is ever going to go away. We're not going to get to zero COVID. And I think that's also part of what we're seeing in China right now. One of the things that we're hoping to see is that we get on a cadence similar to flu, where we're getting vaccinated on a regular schedule, we're minimizing the impact of the disease on our life, and we're reducing spread wherever possible. So I think we're still in this sort of peri-emergency phase where we're just figuring out how to live with COVID. It's still certainly quite dangerous, but as we get on that, routine vaccination schedule, as we get more and more data on how and when we need to vaccinate people, and as we come back to sort of believing in the science of vaccines and all of the other tools we've built in a very short amount of time, that hopefully we will be able to live with it in a much less painful way.
Hope is not a strategy. This is the reason why I say that is because we're talking about masking. We're talking about how you should probably be careful congregating with 20,000 of your closest friends. And yet I can pretty much guarantee that Matt Miller will still be at that Fish concert and he will not be wearing a mask, and neither will anybody else in there. I'm just going to suggest that. And if you take a look at a lot of the airplanes and you look at that, very few people are masked, and those that are given glances of what's wrong with you. Do you have the flu? Because we all want to get back to normal. So how do you change a culture that is absolutely opposed to masking and using some of the tools that you're talking about?
Yeah, I completely agree with you. I think that it has become very divisive to even talk about, let alone use some of these important public health strategies. I think we have to go back to the roots of explaining where the science comes from, why we use masks when we use them, and maybe the culture won't change. And unfortunately, that is something we may have to deal with. But I think that it remains an option for people, and it certainly remains the recommendation, at least for me. And I think it's important to keep making that recommendation, sort of normalizing that this is a choice that is safe for people to make and is not a political statement. It is a statement where you're saying, I need to protect my health, or I want to help protect the health of others, and I'm going to choose to do that. And so the more we can normalize that, the easier it gets to make that decision. I mean, I know masks are not, they're not the place people want to be right now, and that's completely reasonable to feel that way. And many people are making that choice, but it certainly shouldn't be that the people who do make the choice to mask are judged or are looked upon as making a poor choice.
Too late.
Lauren, just real quick here to finish up, what is the chance, in your view, of our being subjected to a pandemic like the one that we just went through with another mutation of the COVID virus?
I think our chance of going through another pandemic is quite high. I'm not necessarily sure that it will be with a COVID mutation or a variant of concern, but certainly we could see a pandemic with another virus or with a mutation of this same virus in our lives. The risk associated with these new viruses coming into our population just continues to grow, and so if we don't implement the tools that we've developed during COVID, and also some of the lessons learned, making sure that they are lessons learned and not just lessons identified, we will continue to be at risk for another pandemic.
Lauren Sauer, thank you, I guess, but also not thank you. I love talking with you. I love the insight that you bring. I hope that the worst case scenario does not come to pass. I'm sure we all do. Lauren Sauer of the University of Nebraska Medical Center, thank you so much. Have a wonderful new year. It is a little frightening. I saw you recoil, Kailey, when she was talking about the potential for another pandemic. This is the fear that some people have with the reopening of China so rapidly without people who have been fully vaccinated. Although the good news here, just to sort of try to end on a slightly upbeat note. Nice. The good news is, that's so sweet, right? The good news is that we haven't necessarily seen any kind of mutation that is unfamiliar to the rest of the population.
Yet. To this point.
God, come on, guys, help me out here.
Well, that's kind of what she was alluding to. The concern is the more it spreads, the higher risk that there is that it does mutate. I also wonder as well, just aside from new infections, have we really begun to understand the effects of long COVID on a large part of the population? Because
probably
that also has implications for the labor market longer term.
Yes.
When we talk about structurally lower labor force participation, you still have people all across this country and the world who are still dealing with the ramifications of their infections.
So what is it about masks?
Well, I mean, I just don't like wearing a mask. It nothing to do with politics. It's just, I think, a horrible way to live life. And if it were just for me, I would rather get COVID than wear a mask. The problem is I don't want to spread it. I don't want to give it to my wife. I don't want to give it to my baby. I don't want to give it to my parents. So it puts, I think, a lot of people in a difficult position. But I think the more important question is yours, Kailey. What are the ramifications of long COVID? I don't think we know. And it's scary.
And I think that a lot of people feel the same way as you do about masks, which is one reason why perhaps we're at a greater risk of certain additional virus spreads.
Isolation I like better. Isolation.
We can all get on board with isolation. Here's isolation in 2023 from New York.
No.
This is Bloomberg.
Now going into next year, everyone is bearish, right? And we're going to have this massive recession.
It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers and may roll through some of the other sectors in the economy.
Even if we see growth hold up okay, we don't fall into a recession.
We've never had a recession without the claims data going up.
We're expecting a mild recession, but we don't think that it's going to last long.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Just hours to go before 2022 goes down in history books as the year of inflation, the year of bond and stock losses that we have not seen for more than a decade. Good morning. Welcome back. This is Bloomberg Surveillance on Bloomberg Television, on Bloomberg Radio. John Ferro and Tom Keene both off today. I'm so lucky to be here with Kailey Leinz and Matt Miller. I'm Lisa Abramowicz. As we begin the journey, a few more hours, Kailey, before we could try to write a new story of 2023.
Is it going to be better, though? This is the question we keep asking. We know 2022 has been absolutely brutal, and yet the same forces we have been dealing with all year, hawkish central banks, war in Europe, questions around China and the trajectory of the world's second largest economy, none of that goes away 3 days from now when trading begins once again.
Although, Matt, you've raised the point. It's been horrendous for the people who are long. It's been great if you've been short, and there have been a number of people who have been short rates and who've been short certainly certain equities. I'm thinking particularly of big tech.
Or long commodities.
There are trades that have worked. The key that I'm wondering is, do we give up on the reversion back to the Fed put, to this idea of, getting back to an era that we had become used to, or are we embarking on a sea change that we're not fully aware of just yet?
I think it's a really good point. That's what makes the market, right? I wish I knew the answer. But the question is, are we in a new era? I was saying earlier, Howard Marks, he wrote a piece, I think, in the FT saying, this is one of the 3 sea changes of his life. And he's at least 70. So a pretty seminal moment for markets. Or do we revert back to low rates and free money? I really hope so, because as you know, I want this Dodge Challenger. I want to get, did I tell you about the Hellcat that I want?
No, but you can tell us all about it in the break.
So, and right now I'm looking at 7.5% rates on a Chrysler loan. So it's not really worth it for me. And I think a lot of decisions are being driven by that, right? You're seeing home sales come down at a pretty breathtaking pace. Yeah. So, and the same is going to happen with new cars. Prices are dropping for used cars. I'm really watching it very closely.
So you're seeing the impacts of tighter monetary policy showing up in some areas already, those very rate sensitive areas. You're not seeing it in the labor market in a material way quite yet. And ultimately, isn't that what the Fed needs to see?
Well, and this is the issue, right? This has been one of the big questions. You've had an incredibly tight labor market. The initial jobless claims, the last ones to end 2022, didn't really show a material loosening in terms of people getting laid off, at least not those who can file for jobless claims. That said, there is a question about the structure of this labor market, right? And whether it just is just a fewer people who are able to work, whether it's long COVID, whether it's fewer immigrants, whether it's the fact that people are retiring early. This all raises a question about what the reopening of China has to do with this and the global tightening cycle that has already taken place, Kailey. How much can you say the U.S. is basically over, go to the rest of the world, versus the U.S. still can structurally be the leader?
Well, we're talking about structural changes here, right? If we're talking about structurally lower labor force participation, if we're talking about, therefore, structurally higher inflation due to a multitude of factors, how can we still put faith in a reversion to the previous norm if we are just talking about a different global economy than previously existed.
Yeah, and right now we're looking at a year ending with a whimper. We're seeing a bit of losses. As we end 2022, we're also seeing yields climb just a touch higher after a pretty amazing rise across the board, particularly on two-year yields, which have had a notably horrendous year. The weakness ongoing at session lows, 0.6% decline, 38.47 on the S&P, given expectations among the biggest bulls for above 5,000 to end 2022. So what will happen with the consensus being for next year to end the year around 4,000? We shall see. We're seeing a bit of dollar weakness, 106.77, 10-year yields climbing just a bit, 385, considering that it started the year at 150, and a bit of softness in crude, $78.10, down about 0.4%. Will next year be the year of the bond? Eric Knudsen joining us now, multi-asset class CIO at Neuberger Berman. Eric, I want to start there because that seems to be one of the consensuses out there. This will be a great year, particularly in government debt. Do you agree?
We do. And 2023 could continue to be pretty challenging for stocks, but we do think that we are at a bit of a sea change. I've been doing this almost as long as Howard Marks, and I would agree that the next period of time is going to be quite different from the last 10 to 15 years we've seen. And one of the key elements there is that rates have to be, in our view, structurally higher, associated with higher structural inflation. And the Fed's determination, and frankly, the capital markets need to have a real positive real yield across the government bond curve. The Fed is forecasting that rates at the end of this year are going to be 5-ish%. Growth is going to be 0.5%. Inflation is going to be 3.2%. That's a real yield of almost 2%. We haven't seen a real yield like that consistently for over 15 years. We think you should pay attention to the Fed, and this is a dramatic change from the environment we've seen over the last 10 to 15 years.
Do we see a pivot, Eric, in 2023?
That's not our expectation. The Fed, we believe the Fed and other central banks are going to need to maintain tight financial conditions through 2023. You see it with the Bank of Japan beginning their normalization process even earlier than people expected, and that then encourages the rest of global financial conditions to tighten. And now what appears to be an even more rapid and perhaps chaotic and disorderly, reopening by China, which could lead to more rapid growth, more robust growth from China sooner rather than later. That just adds to the need for global central banks to keep financial conditions.
I thought about actually buying my Hellcat by shorting JGBs, but I can't get a borrow, and now with the yen strengthening, that would kill me.
Is there anything else you want to vent about?
No. I just think it's an interesting trade that now I understand really when I look at the yen right now, 131, why it's called the Widowmaker. In terms of in terms of what else to expect for 2023, where do you see earnings? Because this is something that a lot of people have flagged to us as maybe the most important part, certainly in the equity space, right? We're still expecting $210, $220 a share. Does that need to come in?
Absolutely. Well, so there's a huge difference in opinion between strategists and macroeconomists who are expecting a recession and who are projecting earnings anywhere from 180 to 210 or so dollars per share. And that assumes a recession and that, or even radically slowing growth, even if we avoid recession, that's normally accompanied by earnings declines of 10 to 30%. Bottom-up consensus Wall Street forecasts are still expecting earnings in 2023 at about $230 a share, up 4-ish%. Our view is that earnings have to come down from that $230 target percent. Whether they get to 180, we're not quite that bearish. We think that there are corporate management teams have various levers, especially in a more inflationary environment, to support earnings. But we think they end the year below the current $220 per share that we expect for 2022. And that's the last leg down. That's the last source of pressure on equities.
Is that more on the demand side that earnings pressure is going to come, or on the input cost side and supply?
Some of both. The margins have to come under pressure. They're still almost at secular highs. That has to normalize to a certain degree. Corporate management teams, particularly in the United States, have gotten very good at managing margins, but they have to come down somewhat. So it's going to be a mix of both top line pressure as well as pressure on margins.
When do we start to go back to a new normal, right? I mean, at what point can we reset and understand whether we just can expect low returns for the next decade in equity indices, or perhaps a reversion back to the Fed getting to low rates and some sort of pre-pandemic norm?
Well, we don't believe we're going back to the new normal of the last 10 to 15 years with low inflation, low rates, financial repression, et cetera. We think we're going to a more normalized rate environment with structurally higher inflation, in part because of a fundamental change in the relative power of labor versus capital, which you guys were just talking about, in part because of deglobalization, in part because of decarbonization, in part because of changing demographics and the changing role and relationship of China with major trade partners and with their domestic policy. So we don't think we go back to the new normal anytime soon. We're really going back to a more old normal, more typical environment. Doesn't mean there aren't going to be interesting opportunities. We see great opportunities in short duration fixed income. 2-year treasuries at 4.3% yield. They're battling with S&P 500 earnings yield. You haven't seen a comparison like that since 2007. Short duration treasuries, short duration investment grade credit, mortgage-backed securities, structured product we think will be very interesting this year. Within the U.S., we like value stocks, quality stocks, high dividend yielding stocks, money now as opposed to money in the future, that now you've actually got competition from the risk-free rate for your capital.
Eric Knudsen doesn't necessarily paint a particularly wonderful picture for returns for equities, but certainly the short term of the Treasury curve. Eric Knudsen of Neuberger Berman, thank you so much for being with us. Have a wonderful new year. It's hard for me to say, have a wonderful year after people come out and they're saying it's going to be really bleak. Matt, just, hide under a cover, hide in cash. And that seems to be a belief. Cash pays something suddenly.
Yeah, it's also not so bad if you can get a decent return,
exactly.
Right?
It's actually probably it's the old normal, right?
I remember hearing my parents talk about the Volcker era, and they weren't involved in financial markets, so they weren't exactly talking about the Fed chair, but they were saying there was a time when we had 17% mortgages, but we also got 12% on treasuries, And I always thought, man, I would love to own some of those. Now maybe you have a chance.
Well, yes, okay, but you don't unwind everything that's happened in between the old normal and the new old normal. And how do we get there, right? I mean, if you start to talk about, you had to pay 13% on a mortgage. Well, if you go back to that, Kailey, what does that do to home values? What does that do to the availability of credit to people who are buying for the first time?
It wouldn't be good. That would be pretty bad, I think, is the general answer to that question.
Right, which is the reason why you've seen such a slowdown. But I just wonder whether you see sort of, big pops or whether it's just sort of a slow deflation like we've seen this year.
Yeah, it's a really good point. I was just looking at the 2-year Treasury yield, which he was talking about, still at 4.4%. That's below where the Fed says it's going to be.
Right.
I mean, shouldn't those come more in line?
Well, people think that the Fed's going to cut rates, which is exactly your point, Matt, that the Fed's going to cave. And whether they do, of course, remains to be seen. We'll get a view on how much people continue to spend despite some of the inflationary headwinds. We'll speak with Dana Telsey coming up, founder and chief executive officer of Telsey Advisory Group. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine. The U.S. may give Ukraine's ground fighting capabilities a boost. Bloomberg's learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25-millimeter gun. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was part of a push to influence crypto policy and build connections before his FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. In Myanmar, Bloomberg's learned that deposed leader Aung San Suu Kyi has been sentenced to 7 more years in prison after being convicted of corruption. It was a final round of verdicts against her since the military ousted her democratically elected government in a 2021 coup. Suu Kyi's total prison term is now 33 years. And in Canada, the merger court has cleared the way for the union of 2 of the country's biggest telecom firms. The Competition Tribunal ruled in favor of Rogers Communications' $14.8 billion deal with Shaw Communications. The ruling said the federal antitrust commissioner failed to prove the merger would cause significant harm to competition. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I'm not going to tell you there's no risk of a recession. I think there's a 40% risk of a hard landing and a 60% likelihood of a soft landing. It's been a rolling recession. It's rolling through the housing market. It's rolled through retailers, and it may roll through some of the other sectors in the economy. But altogether, the economy is holding up.
It has rolled through retailers, and yet consumers do keep spending, and it raises a question of whether it's already got kind of shaken it out in terms of how much pain there is to come. That was Eddie Ardeni, Ardeni Research President, with some optimism yesterday, talking about how maybe we just don't land at all. And this is something that a number of people have been talking about. I do wonder, Matt, how much we're going to end up seeing retailers kind of come back, because they've had so many years of underperformance. They've had so many years of consolidation. They're now actually not laying people off, and they now have the ability to be more flexible and nimble and start investing in some of the infrastructure that they've been needing.
Yeah, and I think, well, especially this year, we've seen some real differentiation, right? I think Tom called it bifurcation when I was watching surveillance, because some of them have been able to manage inventory well and others have not. And that has been a problem, specifically for Target.
And Kailey, there's a question about just at what price people are willing to pay. Yes. And you've been talking about discounting. A lot of people have been talking about discounting. What does it take to clear out that inventory? And then how persistent is that? Is that going to be a trend, or is that just, a one-time thing to get rid of anything that's excessive?
It's the difference a year makes, right? Because last holiday season, we were talking about goods that were stuck on ships and on trucks in a supply chain that was a total mess. Therefore, there was such a limited quantity of goods, people were willing to pay up for them. Now it's entirely different. There's too much stuff that people, frankly, aren't trying to buy anymore. So they're less price tolerant. Let's get a take on this. Dana Telsey, founder, CEO, and chief research officer at Telsey Advisory Group. And this is the exact dynamic that has led to an inventory glut in retailers like Target that Matt mentioned. Do we have a sense of the progress they are making in doing that discounting and working that inventory down?
Hi, how are you? Thank you for having me. I think overall, what surprised people coming out of the third quarter is that the retailers did make progress in lowering their inventory. There should be more progress made by the end of the fourth quarter. And as retailers report their preliminary holiday sales results, many of them the end of next week, the beginning of the following, watch for those inventory numbers. I think they did make progress. I think some of these markdowns and discounts that they have, even buy one, get one 30% off for some, definitely help to pave the way, but it'll still be at least through the first quarter, because don't forget, you need wholesale accounts to order, and wholesale accounts like the department stores are ordering very carefully, down around 10 to 15% from what I hear for the spring selling season, with the goal for both the brands and the retailers to get back in focus to promote less.
Promote less. So you're saying that that doesn't need to continue, even if we are looking next year at an economy that, if it doesn't fall into an outright recession, could soften, because in theory that also brings down consumers' spending power.
Keep in mind a couple things. When you think about the bifurcation of the consumer, the middle to high end still has dollars. They have dollars to spend. It's product innovation that drives demand. They'll be looking for bargains, and the benefit is going to be the trade down to the off-pricers. The lower to middle income consumer, you're going to see the Targets and the Walmarts move through inventory, and the focus on essentials will be even more for those consumers. So I think we should have not the same cadence of promotions, but the value offering will be even more dynamic than it was this year. They'll be able to get goods at more compelling prices, because you're not going to have hopefully higher gas prices like what you had last year.
Well, and the question also is whether how much people have shifted some of the supply chains away from China during this time, or whether the reopening of China will actually allow a lot of these retailers to buy goods at lower or more compelling pricing. Tina, how much have you seen a real rejiggering of where some of the clothing, where some of the items are being manufactured over the past 3 years?
we've seen a lot of rejiggering. And I think the ability to diversify from China has been in place for a long time. I think the change for 23 is going to be the cost of ocean freight rates, the cost of air freighting, and frankly, not even air freighting as much goods in as they had in the past. What's going to be sticky is higher labor costs. That is not going away. What is going to moderate is going to be those supply chain costs that should give retailers more flexibility. Promotions will be higher than they were in 21. They'll be higher than they were in the first half of 22, but hopefully we're not going back to 2019 levels.
It's interesting. You know, I was in Detroit a couple of months ago talking with Mark Royce, and obviously automotive is a little bit different than the retail that you're covering, but he was saying, look, we're not going to go back to the days of big discounts. We're not going to go back to the days of packed dealer lots. We're going to keep selling these products at MSRP, and he has to be confident that CEOs of other car makers are going to act the same way, right? Can retailers try and follow that same strategy, or will they undercut each other?
I think overall, when there's as much inventory glut as we've had, I think they're all being aggressive. You've seen after the holiday season what Target did with their clearance event. I think when Amazon had their second Prime Day in October, that basically opened the spigot for Target, Walmart, and Old Navy to discount aggressively. I think getting the inventories more normalized, you're not going to no promotions, but you're not going to have the burst of promotions with 70 and 80% off that we saw in some instances this year.
Dana, we were talking yesterday a little about pickleball. The rackets made in China are so much cheaper than the rackets made in the U.S. And today somebody on my Twitter feed mentioned Snap-on tools. They're also incredibly expensive, made in the U.S. compared to the Husky tools you see at Home Depot made in China. Is deglobalization really going to happen? Because the price differences are really pretty massive. And so I wonder, you know, if we go down that road, is it inflationary?
You're absolutely right. I mean, what we've seen is the ability to produce goods in China, and frankly, the quality, the speed that it takes, and the cost is lower. We've seen the focus on diversification, whether to South America, whether to Africa, whether to America, but managing price is key. Whether it's raw materials, labor costs, or shipping, I think China will always remain relevant. I think the percentage coming from China will continue to be reduced.
Dana Telsey, thank you so much for being with us. Dana Telsey of Telsey Advisory Group. Happy New Year. Have a wonderful end of the year. As we wrap up 2022, I just want to bring you a couple of things. Germany's stock market, the DAX, just closed officially for 2022, and it is down more than 12%, the biggest annual loss going back to 2018. Also, Kailey, we are seeing a leg lower in futures ahead of the U.S. Open, with the NASDAQ now down more than 1%.
Yeah, and the steepening of losses in futures corresponds to a steepening of losses within the bond market as well. Yields just took a big leg higher on the 10-year yield. We're up more than 5 basis points now to just about 387. Obviously, liquidity is not abundant on this last trading day of the year, so we have to keep that in mind. Not even that big trades could lead to sizable moves, but basically this just caps off a year in which you didn't really want to buy bonds, you didn't really want to buy stocks, and your 60-40 portfolio performed the worst since 2008.
And you raised a question about liquidity. Suddenly we have a two-way market, Matt. I mean, that's something that's new. For a long time, it was don't fight the Fed. Now it's maybe don't fight the Fed, but what does the Fed want to do depends on the data. This is now a much more price discovery-based market after years of not having been so. Yeah, well, that's obviously makes it more interesting for us and for market participants. You can have an edge. You can be a winner or a loser. I wonder if you're going to see a decoupling of the buy or sell everything mentality, because, if we see a sell-off in futures and bonds, that doesn't bode well for the comeback of the 60-40 portfolio, does it? Are we going to see that being more of a diversifying tool? Well, and that's the reason why some people are, that's why, again, it's two-way market, but that's why some people are saying that it's going to take the Fed actually seeing the data that suggests that inflation is coming down before they go fully into bonds. The long bond was a consensus trade a month ago and then suddenly was less so ago as it rallied. People saying perhaps it doesn't offer the same kind of trade. But Torsten Slok this morning of Apollo, Kailey, coming out and saying, look, when you see recession expectations going up like this, that actually is good for the long end, because that will ultimately be disinflationary, and ultimately people will seek out the haven trade of U.S. government debt as they have in the past.
Well, and maybe you also see a reflection of, if you do indeed see that recession materializing, the Fed's going to stop talking tough, and they are actually going to have to throw in the towel and turn the other way.
Although I do think that it's interesting, and this is something we've been seeing, that the NASDAQ has been losing more as yields go higher. Mm-hmm. How much more does that trade have to go in terms of big tech being more interest rate sensitive than the rest of the sectors? Right now, 0.7% decline in the S&P, heading for a 38.45 close for 2022, 106.55. A bit more of dollar strike suddenly reasserting itself, and 10-year yields 3.87, 3.87%. This is Bloomberg. This is Bloomberg Surveillance on the last day of 2022, the last trading day, I should say, on Bloomberg Television, on Bloomberg Radio. Tom and John are off going through the countryside of the United Kingdom, looking for the perfect tot outfit for Tom. I am so lucky to have Kailey Leinz here and Matt Miller as we take a look at a soggy day that is getting even soggier. Kriti Gupta has a check on those markets. Kriti.
Yeah, Lisa, the sell-off accelerating when you look at futures trading. The S&P 500 continues to see red on the screen, and it just gets deeper and deeper. Take a look at E-mini futures down about 0.7%. The stock market isn't alone. It's the bond market as well. Yields are now higher by about 6 basis points, 387 on the 10-year yield. And it's the dollar story, I think, that's starting to drive it a little bit. It is now following the move that you were seeing in the 10-year yield, which was not the story an hour, 2 hours ago. You saw that divergence now. The dollar coming back a little bit, pressuring the euro, which was actually one of the top gainers this morning. We're now looking at a 106 handle on the euro, about weaker by just 0.1%. Once again, nothing to write home about, but it's that intraday dollar trade that is moving the market. I want to give some special attention to gold here, because we talked about copper, we talked about oil, especially in light of the China reopening trade. Well, gold is very much a part of it. It is no longer the haven asset, especially as we go into January and the Lunar New Year. So that demand from China, watch gold and see how it kind of performs, because that could actually be the canary in the coal mine to actually see whether the China trade is indeed turning around. Well, let's bring it back to the equity market and the bond market as well, because it's the relationship between the two that's really crucial. Kailey has been talking about the 60-40 portfolio nonstop this week, and I think it's really important to bring up, because as we talk about that real yield getting juicier and juicier, for lack of a better term, the stock market loses its appeal a little bit. And you've kind of seen that this year. As the yields go higher, the stock market goes lower. Some of that is, of course, the effect on valuations and borrowing ability, and, of course, the effect on cash on some of these balance sheets. But I think it's also important to look at what it's doing underneath the hood to the sector basis, because as you see the yield once again go higher, think about what 2023 might bring for the bond market. The idea that it might create a bull case for the bond market as we start to see the Fed end that tightening cycle. But what it's going to do to the stock market as a result is actually hit some of those yielding sectors in the stock market. I'm looking at real estate, for example, consumer staples, utilities. And real estate, by the way, has really taken the brunt of the hit as we start to see the yield climb down about 27% year to date, relative to an S&P 500 loss of about 19%. So you can really see some crucial underperformance there, whereas consumer staples, utilities, the dividends there have actually held up, Lisa.
Kriti Gupta, thank you so much. Let's stick with real estate. We talk a lot about individual single-family housing units and how much the sales of homes have slowed. The commercial real estate market is in its own world of hurt, since you have seen a real wholesale move away from office space, when you see also this question of where is the international investment going to come from? And parsing through all of that every day, Charlie Rose joining us right now, Managing Director and Portfolio Manager at Invesco Real Estate. So just let's start there with this question of just how much further do we have to reevaluate commercial real estate in some of the major metropolitan areas that used to attract investments from China, that used to attract investments from big companies looking for big office space?
Sure. Well, you spoke earlier on the show about the real sea change that we're seeing in the investable universe as a result of the departure from the zero interest rate environment. And so what we are seeing is that real estate investors are reevaluating their portfolios in this period of time and are really taking another look at real estate credit as a way to play the real estate industry. Real estate credit offers that deep subordination that provides protection from volatility in a potentially risky environment for valuations, as you've hit on, and also offers that immediate upside in a floating rate structure from a rising rate environment. So there is a significant amount of uncertainty in the real estate space. Some of that is very asset class specific, but real estate credit is a way that we're seeing a lot of investors try to play this current market environment.
Charlie, let's zoom out because we heard about some of the UK real estate funds that were frozen to withdrawals as a result of just how much people were trying to pull out. There is this question, especially as banks and pensions have traditionally been the investors in some of these properties, of whether money will be sticky and what the consequences will be if it is not. How much are you seeing a wholesale rethink in the investment space, in your space of real estate funds, in terms of what types of terms on withdrawals are placed?
Yeah, so withdrawals have been a hot topic. We've certainly heard you talking about it and others talking about it a great deal. I think a lot of investors are looking for liquidity and looking to understand how to play the difference between the public markets and the private markets. In our space, in the credit space, we have seen relatively limited withdrawals. In fact, actually, investors are looking to double down and increase their allocation into credit. Real estate credit in the U.S., private credit, is a $5.2 trillion asset class. So that's fully 25% larger than the muni market, about half the size of the corporate bond market. And historically, it's a segment that has been dominated by banks, insurance companies, and CMBS, and has been less accessible to the institutional retail investors.
So, and Charlie, there's a real differentiation, as I understand it, between the fundamental business of commercial real estate and the value of commercial real estate debt, right? Because of the scarcity of the latter.
Yeah, absolutely. We have seen a real phenomenon. 2022 was 2 years in one. The first half of the year, we saw record-breaking transaction levels, both on the equity side and on the credit side. And that really dried up. And we are seeing the conventional lenders who dominate the market, banks, insurance companies, as a result of the rising rate environment, they're seeing far fewer payoffs in their existing portfolios. And so that's impairing their ability to make new loans. So that's really creating an opportunity for new entrants in the space. And it's become a true lender's market. As a real estate lender, you're benefiting from higher base rates. Spreads have gapped out, so you're getting that double impact from returns, and you can really name your terms in an attractive way: lower attachment points, lower detachment points, and better structural terms.
So what is the effect of the Federal Reserve's quantitative tightening program on your markets? Because they hold obviously a huge amount of MBS and agency securities, and I don't know how the knock-on effect is from that to commercial real estate.
Yeah, it's been very significant and it's been immediate. Certainly, real estate is a levered asset class. And we have seen in the real estate equity market, really the current dislocation is a capital markets driven dislocation. Fundamentals across the board have remained very strong. You talked about earlier on the show, how long does it take for some of the Fed action to trickle down to the real economy? We'll see in the real estate sector. But for the major asset classes where we're focused, the multifamily, single family, for rent, industrial, some of the specialty asset classes, fundamentals remain incredibly strong. Rent growth on a year-over-year basis is still in the double digits. Occupancy is close to record highs. Demand is above trend from a net absorption perspective. So what we're seeing right now is the rates environment really being where people are having difficulty.
Well, higher rates already have materialized. A lot of the softness that is intended to come with them hasn't yet. Charlie, how are you thinking about the risks of a recession?
Yeah, so other investors' pain likely our gain from the credit side of the house. Risk of recession is certainly something that we're very focused on. We're global investors. And so we're looking in Europe, we're looking in North America. You talked earlier on the show about elevated recession risk in Europe, that already is creating opportunities to lend at a lower basis with a higher spread in that market. So opportunistically seeing opportunities crop up there. And in 2023, we're looking for the same in the US as well.
What about in China? Curveball question.
Yeah, China is not an area where we've focused on the credit side historically. China is an important market for us and is one that we're constantly evaluating for the real estate credit side. Asia Pac, generally speaking, huge opportunity. Demographic trends are positive. But historically has been more dominated by local players.
Charlie, before we let you go, we're in New York City, and there's a real question of whether the urban centers that used to be havens for office space are going to come back in the form that they were 3 years ago. Are you a believer that there will be some sort of full occupancy at some point in the next 5 years?
Yeah, it's a really good question, and I sit here in downtown Los Angeles, which is even harder hit than New York City. The office segment, from a real estate investment perspective, first we should level set, is a much smaller portion of the asset class than it has been historically. Within REITs, it's sub 6%. Within the Odyssey Core Index, it's about 23% today. We will anticipate that institutional investors will continue to pivot out of office. I think there is a lot of uncertainty about that return to office space. What we do know is that the best assets are performing very, very well. You can see that in New York City, the One Vanderbilts of the world getting record high rents and record high occupancy. But it's really a story of have and have nots in the office sector. And that's why we've been really focused on those asset classes where we have secular convictions, industrial, multi, and specialty.
Charlie Rose of Invesco Real Estate, thank you so much for being with us. A fascinating moment. And Matt, honestly, it's, to me, one of the biggest question marks because there have been so many changes. It isn't just interest rates. It also is the pandemic, as you were talking about, this question of whether office space is relevant. And then if so, what it looks like, because it's not going to be the traditional cubicles necessarily to draw in workers.
Yeah, that's a great point. I mean, Business Week has done really good work on this year with a great piece on 3rd Avenue and the fact that the kind of office space that we have here is just not the kind of office space people want. I mean, Charlie made that point as well. One Vanderbilt has rents that are soaring, whereas a lot of big buildings on 3rd Avenue, even some relatively big ones, can't fill up their most important properties.
Yeah, and they're doing a study right now, I know in New York and other cities, in terms of converting into single-family housing units and what that will cost. And it actually is more expensive in some cases than just building a new building.
Than knocking it down.
To start, from start. So, I mean, there are real questions about what happens, even if you do try to change some of the zoning. Matt, I know you're going to leave us. Where are you going? What are you going to be doing on the open today?
I'm going to go on the open, and we're going to focus on the last day of trading. Obviously, we've seen equity indexes start closing around the world. We have a gain of almost 1% on the FTSE for the entire year. We have the worst loss on the DAX at the end of the year since 2018, which isn't very far back.
I know.
But they lost 18% in 2018.
And I believe Dan Ives will be joining you, a great voice to end the year in terms of tech. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's being called one of the most intense missile and drone attacks of the war in Ukraine. The barrage rocked cities across the country, including the capital of Kyiv. Ukraine says it shot down 54 of the 69 cruise missiles. Still, it's likely that Ukraine will ask Western allies for more air defense systems. After a week-long meltdown, Southwest Airlines plans to return to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It's been difficult to obtain accurate data since the COVID-0 policy was lifted. Some tense moments over South China Sea. A Chinese fighter jet flew within 20 feet of a U.S. Air Force reconnaissance plane. The U.S. military says American plane had to take evasive maneuvers to avoid a collision. China asserts rights to more than 80% of the South China Sea. And British fashion designer and environmentalist Vivienne Westwood has died. Westwood became a star in the 1970s for her punk and urban style streetwear, staging runway shows in London, Paris, Milan, and New York. She was a lifelong rebel, honored several times by Queen Elizabeth II. Westwood was 81. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We're expecting a mild recession. We don't think that you're going to get a soft landing. We think you're going to get something between a soft landing and a hard landing, but we don't think that it's going to last long. And the reason for that is because look at where we are from an employment standpoint. The labor market is extremely strong in the U.S. It's not going to be until the second half of the year that things start to slow down.
That was Kevin Nicholson, Riverfront Investment Group Global Fixed Income Chief Investment Officer, as we wrap up a tumultuous 2022. Basically, take a dartboard, throw a dart, and there is your forecast for 2023. That's what it seems like. Kailey Leinz here. As John and Tom take the day off, a much-deserved break, we are seeing markets sag into the open here, down 1% on the NASDAQ, Kailey. And I'm really noticing how there's this weight to the tape, despite this feeling that you typically end the year with a little bit of a breath of optimism, especially after the worst losses in more than a decade.
Yeah, and we tried to take that breath yesterday. You actually saw a pretty decent rally for U.S. stocks, and yet we're giving a large chunk of that back today as we close out a year that has been so painful for equities. And it raises a question, Lisa, of when the calendar resets, how far away are we from things actually improving in the equity outlook? Because if you believe the strategists, which it's up to you if you want to believe them, considering how wrong most of them got this year, if you do believe them, there is more pain to come. We have not actually yet hit the bottom because we have not seen the rolling over in earnings. We have not actually seen much of the real economic pain that the Fed is in some ways trying to engineer.
Because it's the last day of the last trading day of 2022, we can talk in big sweeping terms, which makes me incredibly happy and be all philosophical about markets. The paradigm shift that we've been talking about, right? This question of whether we're seeing a sea change, unlike what we've seen in the past couple of decades in terms of higher inflation and higher rates, raises really a question for the upcoming year of whether we get a normalization of the real economy doing better, even as equities do worse, right? Do we have to see some of the pain taken in margin compression that perhaps goes back to the real economy in terms of higher wages, in terms of continual investment in tech? And this is really sort of the perversion of using the stock market as a gauge of the economy, because it hasn't been for so long.
Yeah, that relationship is entirely broken. And usually this market is front running what is actually happening in the economy. It is looking far ahead into the future. But to your point on throwing a dart, no one actually knows ultimately what the future is going to bring. And as we talk about the idea of quote unquote normalization, it is one thing for inflation to cool. It is another thing for it to cool back to 2%. It is one thing for the Fed to stop hiking rates. It's another for the Fed to bring us back down to zero and for money to be free once again. We have to make a distinction between a cooling and an actual reversion to the previous normal, which I don't think that the market is really ultimately making that distinction right now.
Especially considering the fact that if we're not going back to free money, some of the investments that really prospered are not going to come back. And we talk about SPACs, we talk about certain tech companies, we talk about crypto assets, but we also talk about sports. And I know this sounds like a hard pivot, but if you remember 12 months ago, everyone was talking about owning a sports team and investing in, any kind of shoe of any type. I'm not talking from personal experience or from my sons.
There's bubbles of all kinds,
exactly.
Right? But on the point of sports, as Lisa alludes to, there's been a lot of interest in sports, and sports collectibles has spiked in recent years, with investors pumping cash into new ventures like Derek Jeter's trading card business, Arena Club. Members can create online showrooms to buy, sell, and trade their card collections, and items are graded and kept at a central vault, with users receiving digital proof of their ownership for their collectibles. Earlier this month, Quick Take's chief correspondent Jason Kelly sat down with the iconic former New York Yankee player and his business partner, Brian Lee.
The trading card industry would almost seem like it was a secret society for years. Right. And now you're seeing Mickey Mantle cards being sold for what, $12 million. Yes. So I think now there's just a lot more attention to the industry. And that's why the idea of Arena Club came about.
Let's start with the news. You've got a lot going on with your company. You know, what's happening?
I first met Brian, this was years ago. I think it was shortly after I retired, and everyone knows the success that he's had in the entrepreneurial world. And we started having a conversation about trading cards. And my parents used to have all of my baseball cards when I first came up, whether it was minor league cards, rookie year, and we had a flood at our house. So we had a lot of things that were ruined. A lot of the cards that I had collected, and you know, a lot of times you try to build businesses, and you know, it starts with, does it make sense? And this just made sense to me. And you know, we're excited about Arena Club.
Yeah, we're super excited to join forces here. And the idea was to truly digitize the physical and to create these online showrooms for folks to buy, sell, and trade. We really wanted to bring to life the passion of card shows and card shops and so forth, and have people experience that online 24/7, anytime they want.
So we've seen some interesting sort of twists and turns over the last couple of years, especially with the digital aspect. How does the sort of NFT play into the business case here?
When someone sends in their cards to Arena Club to be vaulted into our system, we digitize it, we put it on blockchain, and you do get we're calling it a digital proof of claim. Some people might call it an asset-backed NFT of that card. So it's a digital representation of the physical card.
And so obviously you have a little bit of a different relationship with trading cards. How did you view them sort of coming up as a kid?
Yeah, we've joked about this. I got trading cards just for the gum.
Yeah.
You know what I mean? You know, but that's why we got cards. And I just remember sitting down, you know, I was a big Yankee fan growing up. My grandmother, huge Yankee fan, talking about Babe Ruth cards that she had back in the day. And I just started collecting all the Yankee cards. And then, you know, you have a dream of one day being on one. But look, you talk about having passion for trading cards. Brian's that guy.
Yeah, most kids stop collecting, right? But I just kept collecting in high school, college, law school, young adult, old adult. I'm still collecting today, so it's a lot of fun.
You know, Honest, I think, is probably one of the companies that people know you best for. You know, what do you take from those experiences that you apply here, Brian?
I think throughout my career of being an entrepreneur, I get very passionate about what I work on. And that passion bleeds into the team, it bleeds into the consumers. I think we're definitely building that foundation to build a company that will be around for generations for kids to enjoy.
Where is baseball right now? I mean, it's America's pastime, exciting season this season, but what needs to happen for baseball next?
Look, baseball in my mind is the greatest sport in the world, but look, you can't kid yourself. The younger generation, they want to see more action. You know, baseball, you can go 15, 20 minutes without seeing a ball in play. And the days of sitting down in the stands and talking to the person to your left and right, those are way gone, right? Now it's people want to be entertained. They're on their phones all the time. So you have to figure out a way to increase the action because it is entertainment. No matter how you look at it, people want to go and they want to be entertained.
I'm just a fan of this sport. It's my favorite sport. Nothing makes me happier than going to a ball game with my son and my family and rooting for my team. I think...
what team is that?
It's the Los Angeles Dodgers. Sorry, Derek.
That's all right.
He just wanted to press the point. It's fine. I'm a Braves fan, so like this is an uncomfortable table to be sitting around right now.
I can tell you everything the Dodgers need to do this summer. I mean, if Aaron Judge, if you're listening to this, hopefully you'll be a Dodger next season.
Boy. Oh, good Lord. I feel like we're going to throw hands at this point. Anyway, guys, thank you so much for the time. It's really good to be with you.
Thanks for having us.
Quite a story, especially considering the fact that they were coming up with tokenized NFTs to represent the trading cards on a blockchain. Honestly, this is something that I've noticed come up over the past couple of years, whether it's sneaker exchanges where you can trade your Air Jordans or whether it's trading cards and creating a platform for them to have real currency value. Again, I just wonder how much this is an outcropping of, free money and an era where people believed in modern monetary theory, and whether that will lose some steam. We have seen the sneaker resale market lose some steam, or whether this is going to have a real place because a lot of people bought those for more than just the gum.
Well, and it feeds back into the crypto world and the day trading world, the idea that people were armed with stimulus checks and a lot of lining in their pockets. Frankly, we are living in a different world now. at the end of 2022. So it's a good question. How much of that kind of behavior is eventually going to return, or was that just a moment in time when we were at the peak of free money and stimulus and we're not going back?
Some things to look forward to, considering that we are in the last trading day of 2022. Early next year, we get the beginning, maybe, not yet. The trading day has not fully opened, at least in the U.S. Taking a look going forward, you are going to get bank earnings kicking off, I believe, January 13th with JP Morgan. You also, in the next couple of days, in terms of the first couple of days in 2023, you will get retail sales, initial preliminary results. Some early tea leaves. And for now, we have to leave you with a 2022 of tumult, of sea change, of inflation, heading into the unknown. We appreciate you watching for all of this time. Thank you. Have a wonderful new year. Coming up on Balance of Power on Bloomberg TV and Radio, Kay Bailey Hutchinson, former U.S. ambassador to NATO, will be joining David Weston. Kailey, thank you so much for being with us today.
Thank you. Happy New Year, Lisa.
Happy New Year. And we almost made it. This is Bloomberg.